which is done without proper analysis ends up most of the time being wrong. And the first step towards that is usually having a vibrant academic environment, vibrant conferences. So this is a very good thing.
Ця конференція – це дуже важлива подія для розвитку економічної думки в Україні. Це таке вікно, через яке західні науковці можуть побачити Україну, а вітчизняні науковці можуть побачити, що таке насправді сучасні економічні дослідження.
Конференція зібрала дуже цікавих людей, в яких дуже солідний науковий бекграунд, в яких є академічне визнання за межами України. І саме головне, їхнє дослідження є вкрай актуальні для сучасного Національного банку України. Саме ця конференція ставить дуже принципові і дуже високі стандарти якості проведення наукових заходів в Україні.
It's a great pleasure to be at this top-level conference with an impressive lineup of speakers and a very high level of the debate.
For the central banks to have this kind of conference is a great opportunity to liaise with the academics and also with the colleagues from the central banks all over the world. So this is the third conference for your central bank, and I really expect you will continue this conference for a long time.
Бачимо, що дійсно для аудиторії такі теми цікаві, тому що це обговорення якісь більш наукових питань, але також практичних питань. Це допомагає людям замислюватися про такі важливі проблеми, яку роль грає монетарна політика, який зв'язок з фіскальною політикою.
Brings together policymakers, academia and media, allowing people to exchange views.
Good time of the day, everyone. Welcome to the second day of our annual sixth research conference jointly organized by the National Bank of Ukraine and Narodowy Bank Polski. My name is Solomia Shpak. I'm assistant professor at Kyiv School of Economics and research at National Bank of Ukraine, and I will chair the first session of today. Before we start, let me remind you some rules of the game. In total, we will have 60 minutes for our session. Each presenter will have 15 minutes of presentation, followed by 10 minutes of comments by discussants, and the last 5 minutes will be reserved for Q&As. We won't be having a break before the next session, so I kindly ask you to follow the time limits. If you are a panelist, please use raise hand function in Zoom, and we will unmute you so you can ask your question. If you are an attendee, please use Q&A section to ask your questions, and we will try to answer as many of them as possible. We have an excellent lineup of papers for today, and we are starting it with the session on new challenges. Before we start with the first paper, let's see the results of the poll. So the statement you had to react to was the following: flexible exchange rates are always capable to protect open economies from foreign shocks. According to the poll, we see that the majority of you say that you somewhat agree with the statement, and we will now see what the recent research says about that. So I'm inviting our first presenter, Gernot Müller from the University of Tübingen, to present his take on whether flexible exchange rates insulate a country from foreign shocks. Gernot, the floor is yours. You have 15 minutes for the presentation.
Thank you. Thank you so much for putting the paper on the program, and thanks for giving me the opportunity to present it here. Do you see my slides? Yes.
Yes, we can see it.
Okay, so this is joint work with Giancarlo Corsetti, Kate Küsser, and Sebastian Schmidt, and we take up a classic question, namely, how much insulation do flexible exchange rates provide? We believe the answer to that question is of first order importance for economic modeling, but also, of course, for policy making, and eventually also to understand the costs of currency unions. Now, the classic view holds that if you go back to Friedman's day, the exchange rate can indeed act as an automatic shock absorber and soften the impact of external shocks. So it does indeed provide insulation. So the classic view goes, and as we just saw in the poll, this is a view which is still widely shared, so I know what I'm up against. Because in this paper, we provide new evidence which suggests that there's no insulation whatsoever. Okay, and in the second part, I will offer a model-based interpretation of our findings, and here's a twist. The twist is that in principle, exchange rate could provide this insulation. So I guess it depends how you understand the question, whether really I'm up against here the majority view or not. So it can provide this insulation, but it does not, because central bankers or monetary policy in open economies face a non-trivial trade-off. And what we observe is the result of one way to resolve this trade-off, namely in favor of stabilizing inflation and foregoing output in stabilization. Okay, so we are not the first, of course, to raise skepticism or foster skepticism about the virtue of flexible exchange rates, right? So there's the by now classic result in Baxter-Stockman, recently revisited by Itoshki and Mukin, which shows quite convincingly that the business cycle in countries which peg and float look very much the same. Yeah? Even though the nominal exchange rate is much more volatile in countries that float, and that also extends to the real exchange rate. Somehow the rest of the economy is insulated from this volatility. And to see that Baxter-Stockman is still alive, Baxter-Stockman is comparing Bretton Woods to post-Bretton Woods data. We update this for our sample, so you have pegs and floats in our sample, and you see that in the first line in red here, the numbers suggest that the volatility of the exchange rate on a monthly basis is about 3 to 4 times higher for floaters than for peggers. But importantly, and that's Baxter-Stockman's striking result, the volatility of industrial production is pretty much the same. Okay, So in the light of this, what do we offer in this paper? Well, we move away from these unconditional moments towards conditional moments. We look at specific shocks. We think that's a useful exercise because it allows us to understand what's going on. With these unconditional moments, you know, a lot of things can happen at the same time. And we discipline our analysis by focusing on one specific shock. There's more skepticism, actually. There's the US-dominated global financial cycle put forward by Ray and co-authors. Yeah, and according to that notion, you have capital flows, which create a dilemma. International capital flows give rise to a dilemma rather than trilemma for domestic monetary authorities. So if you want to operate an independent monetary policy and let the exchange rate absorb shocks, say, that's only feasible to the extent that you manage your capital account. And yesterday in Giovanni's talk, we saw support of this notion because he looked at the transmission of US monetary policy shocks, and indeed you saw large spillovers both for packs and floats, and these spillovers come about according to their findings through the financial channel. Okay. Now, a question which came up naturally in the discussion between Marek and Giovanni yesterday was to what extent that also holds for euro area shocks. And here this paper comes in neatly because it tackles that issue. In our paper, we steer away from that US-dominated global financial cycle by zooming in on the euro area as a source of shock. So that sets our analysis apart from Giovanni's yesterday. We focus on the euro area as a source of shock, and we look at the spillovers onto the geopolitical neighbors of the euro area. What's nice about our sample is we have a fairly homogeneous set of 20 neighbor countries of the euro area. They're fairly homogeneous as far as countries go, but importantly, they differ in terms of the exchange rate regime, both across countries and across time. And we will exploit the variation in the exchange rate regime in order to identify the role of the exchange rate regime in the transmission of foreign shocks. And what we find rather clearly is that the spillovers from the euro area onto its neighbors do not depend on the exchange rate regime. They are the same for packs and floats, and that's what we call the exchange rate insulation puzzle. Because in our sample, we do not find any evidence for insulation. Lastly, there's also a theory-driven skepticism regarding exchange rate ability to provide insulation, and that's related to the notion of expenditure switching, which is at the heart of this ability of the exchange rate to provide insulation. And early on, Deborah Engel have stressed that if you have pricing to market rather than producer currency pricing, then the exchange rate changes would not trigger much of an expenditure switching. And more recently, Gopinath and co-authors have put forward what they call the dominant currency paradigm, whereby most of international trade is priced invoiced in a dominant currency, the dollar in their case, and that also limits expenditure switching. Now, what's interesting from the perspective of our analysis, we think, is that in our sample, it's pretty clear that the euro is the dominant currency. And when we write down a little model to make sense of what we find in the data, we do assume dominant currency pricing, except that the euro is the dominant currency rather than the dollar. And we show that in the model, in principle, despite dominant currency pricing, the exchange rate could act as a shock absorber, but it doesn't, because there's a trade-off arising for monetary policy, which is tied to dominant currency pricing. And in the face of this trade-off, it seems central banks prefer to keep inflation in check rather than stabilizing economic activity. That's the story in a nutshell. So there's some relevant literature, which I skip here in the interest of time. And let me go straight to the data. So we have a data set, 20 years of data, quarterly observations. We take the euro area as the country where shocks originate. We look at 20 neighbor countries. As I said, we select these neighbor countries using the following criterion. We start with the EU 28, including the UK, because our sample ends in 2018, prior to Brexit. We take out all the 11 countries which originally introduced the euro in 1999, and we add the 3 countries in the European Free Trade Agreement by Liechtenstein, so that includes Iceland, Norway, Switzerland. That leaves us with 20 countries, including Poland, not the Ukraine because it's not in the EU. Okay, so that's the criterion for selecting the countries. Then we look at monetary policy shocks which originate in the euro area, and here we use Marek's monetary policy measure, which they kindly share, Yarshinsky-Karadi. We look at exchange rate regimes using the criterion by Ilsetsky, Reinhardt, Rogoff, and we define as floating exchange rate regime all the countries which are classified as category 9 or higher in Ilsetsky, Reinhardt, Rogoff. That involves a fairly free float, lots of exchange rate volatility. And according to this criterion, in our baseline, about 1/3 of our about 5,000 observations qualifies as a float, but we do lots of robustness checks looking at an alternative definitions of the exchange rate regime in the paper. Now, in terms of estimation, we run a simple regression, a local projection, where we look at a dependent variable at some horizon age after a shock takes place, and the shock in our baseline is the European monetary policy shock in the euro area. So that's the epsilon bar here, and the focus of our analysis is whether it makes a difference if a country floats, that would be here, and gamma would be an estimate of the impulse response to the shock in case you float in the period prior to the shock. If you operate a peg in the period prior to the shock, then the gamma p would be your impulse response. That's the idea. We include controls in the baseline. It's only lags of the dependent variable and lags of the shocks, but in the paper we do much more. Okay, here's the main result of the paper. This is the exchange rate insulation puzzle, if you want, because here we're looking at a shock, monetary policy shock, contraction in the euro area. In the left panel, you see what it does to industrial production in the euro area. It contracts significantly. These are 90% confidence bounds over a period of, say, 15 months. On the horizontal axis, you have month. Okay, so that's unsurprising. That's what you expect to happen after monetary contraction. Now, the interesting bit is happening in the middle and the right panel, where we look at a generic peg and a generic float in our sample. And what you see is sizable spillovers. That question came up yesterday. Yeah, so there are sizable spillovers. The effect are in the neighbor countries are as large as the effect in the euro area itself. And importantly, and that's the puzzle, they are no smaller for the floats compared to the peg. Okay, here's the same for unemployment. That's just mirroring this in the upper panels. You see again sizable unemployment spillovers in response to the contractionary shock. Bottom panel gives you interest rate responses, and you see here there's a monetary increase in interest rates in the euro area, and then relatively speaking, also monetary tightening in the neighbor countries. This is the response of prices. Takeaway here, consumer prices in the upper panel fairly flat, producer prices decline, but importantly, again, similar picture. Here we look at the exchange rate, and you see a depreciation for floats in the right panel. So that's the price of the euro in local currency. So that means the euro appreciates, the currency depreciates in the neighbor country, but the depreciation is moderate. Yeah, this pattern in the data, you get it for various shocks. We look also at Marek's central bank information shocks. He showed the results for this yesterday, but we also look at credit shocks, a la Gilchrist module, and you get the similar picture. We address concerns whether this is endogenous currency regime choice, which accounts for our results. We argue it cannot, because typical indicators of vulnerability suggest that our countries do not differ in this regard systematically. Both peggers and floaters are similarly exposed to the euro area in terms of trade openness. Capital account openness is similar in terms of trade volatility is also similar. Okay, theory. I guess I have 3 minutes for theory or so. This is a standard new Keynesian two-country model: monopolistic competition, sticky prices, financial markets are complete, good markets are incompletely integrated. We have the foreign economy stands for the euro area, the domestic economy is the small open economy, the generic neighbor country, if you want. Importantly, we assume dominant currency prices, so trade is invoiced in euros. Yeah, and for the economy, for monetary policy in the domestic economy, we compare 3 scenarios: exchange rate peg, inflation targeting, and targeting of potential output when the output gap is closed, basically. We have a bunch of closed form results in the paper for a special case where we linearize equilibrium conditions. We assume unitary elasticities and special assumptions for the shocks, and we get straightforward results confirming, you know, you're received with them. You have a monetary contraction in the euro area, interest rates go up, output declines, inflation declines in the euro area. If you operate a peg as a neighbor country, you mimic the monetary stance. In equilibrium, we have the same interest rate, output drops by the same amount, and inflation drops by the same amount. So you get sizable spillovers. The interesting bit is, if you have a float, what happens depends on your monetary response. And to see this, well, maybe it's most, well, yeah. So let me, in the interest of time, go to the calibrated version where you see this most clearly. So here we simulate the model. I skip the analytical results, which you have in the paper. So we assume an AR1 shock for monetary policy in the euro area. We add some bells and whistles to the model, and we calibrate the model following Gopinath and co-authors. Yeah. And here's the main result. How much do I have left in terms of time?
You have like 2 minutes left.
2 minutes. Okay, that's great. So here you see in the left column what happens after a monetary policy shock in the euro. Nothing fancy, output drops, and the CPI declines. Okay, and now I want to spend the last 2 minutes on the right panel. Yeah, because in the right panel you see what happens in the neighbor country depending on what monetary target the central bank pursues. Let's start with the red scenario. This is output gap targeting. This is more in terms of intellectual exercise. We think this is an interesting scenario. Here, monetary policy adjusts the interest rate to close the output gap, and indeed it can close the output gap. Yeah. So because potential output declines a little bit, so you see output declining, but it's basically flat. You pay a price for this, inflation goes up. Yeah, so this is the CPI, so you get a jump in the CPI, there's lots of inflation. Okay, you can prevent this from happening. That's your choice as a central bank. You can target the CPI, you can keep it perfectly stable in this simple model. And here you see what happens to output. Into output, you get now a drop which is as large as this drop in the euro area. So this is what we have in the data, this scenario. When you target CPI, you get the same drop. Now, if you would target instead producer prices, that's what you get in Galli-Monticelli, what you do in Galli-Monticelli, what's the optimal policy in Galli-Monticelli, then you would see less of a spillover. Yeah, you would see, but you would still get sizable spillovers. Why is that? Because in our model with DCP, divine coincidence breaks down. So you can no longer stabilize producer price inflation by closing the output gap. Okay, so that's something which is noteworthy here in this DCP world, that divine coincidence breaks down. There's a meaningful trade-off for the central bank, and the central bank resolves this trade-off by targeting inflation more strongly in our analysis. And so this is eventually what accounts for the output spillovers. Okay, this is last picture. So you see the exchange rate response. If you would target the output gap, you would get a sizable depreciation. Yeah, and that would allow you to stabilize output. If you would instead target producer prices, the exchange rate depreciation would be still sizable. And if you target the CPI, then you get very little depreciation, just like in the data. I showed you in the data, these neighbor countries which do float do indeed see their exchange rate depreciate very little. Okay, let me conclude here. What's the exchange rate insulation puzzle? We look at output spillovers from euro area shocks, also unemployment spillovers if you want, and we find that there are no smallers for those countries which do float. Now, in terms of the model analysis, we show that under domestic currency prices, which is the relevant scenario in our setup, closing the output gap entails significant inflation. And if on top of that you target then the CPI, you get even larger spillovers as large as we have them in the data. Takeaway, there's an insulation trade-off. You can either stabilize inflation or economic activity. And if you have a flexible exchange rate regime, you have an autonomous choice of how to resolve these trade-offs. And it seems that what's going on is that monetary policy opts for stabilizing inflation. That's probably no surprise to you, but at a fundamental level, you may still ask, the puzzle still stands, why are policymakers tolerating the exposure of output and economic activity in the face of external shocks? And I think that ties this neatly together with a general debate which we're currently having across the globe. Thank you.
Great, thanks a lot. Let's move to the discussion comments. Discussion for this paper is Alexander Rodnyansky from University of Cambridge. Alexander, you have around 10 minutes.
Thank you. Can you see my slides? Yes, great. Well, thank you very much for the opportunity to discuss this paper. Very interesting. So let me start with the larger motivation. So obviously this is kind of going up against the recent crisis that have stirred up a large debate about the role of monetary authorities and central banks, in particular in the optimal conduct of both monetary and exchange rate policy. So for example, this relates to the mandate of central banks. We heard about this yesterday, whether there's a single mandate, a dual mandate, whether you should target just inflation, maybe the output gap as well. It relates to the central bank independence issue. So again, Alan Blinder spoke about this yesterday, and especially during crisis times, whether we think about central bank independence the same way we do about normally. So this paper kind of revisits this long-standing issue about flexible exchange rates and their capacity to insulate from outside shocks. So this is a classic question that goes back to Friedman and his essays in 1953. Where Friedman famously argued for the case of a flexible exchange rate as a shock absorber, independent of what monetary policy does, actually, just more generally. So
I'm sorry, Alexander, we don't see your slides moving, your presentation moving.
Oh.
We just see a motivation slide. Maybe you can stop sharing and do full screen and then share again.
Just a second.
Okay, now, yes, perfect, thank you.
Okay, so this is where I stopped. So this idea goes back to Friedman. As I said, there's traditional approaches to studying this. You know, the basic approach just relates to kind of comparing output and exchange rate volatility in both the time series and across countries. Some papers doing that. And the other approach is to basically look at structural VRs or local projection methods, as does this paper. So just to fix some idea, what's the conventional wisdom here? If we go back to a very simple intuition with capital mobility, right? So a simple Mundell-Fleming, say, framework, we'd expect that under a fixed exchange rate regime, obviously, and full capital mobility, monetary policy is completely non-autonomous, right? So if there's a contractionary monetary policy shock abroad, right, then the home country has no choice, if it's fixing its exchange rate, other than to import the monetary policy from abroad, so in other words, to raise interest rates as well, right? So there's no autonomy whatsoever. And therefore, you get a contraction on output. Under a floating exchange rate regime, on the other hand, with capital mobility, monetary policy does not have to be non-autonomous. You do have an independent monetary policy, and therefore, you know, if there's a contractionary monetary policy shock abroad, that does not mean that domestic interest rates have to follow through, and therefore a depreciation would entail that there's some expenditure switching and therefore a insulating effect, if you want, or an absorbing effect on local output, right? So potentially output doesn't have to fall that much, it could even rise under certain conditions. So that's the conventional wisdom, the simple sort of Mundell-Fleming logic. And the question is how much of that lives up to the data, right? So this is where this paper comes in, and the main result is essentially the approaches to study euro area shocks, monetary policy shocks mostly, and how they affect neighboring countries vis-a-vis the euro, right? So the main result is the exchange rate isolation puzzle, which just says that euro area monetary policy shocks affect neighbors equally, irrespective of whether these neighbors fix or float their exchange rates, right? So that's the graph that Gernot just showed. So you see on the left-hand side, you know, all the neighbors with a peg, and on the right-hand side, all the neighbors with a float. And following a contractionary monetary policy shock in the euro area, there basically is no difference. So here I'm just showing you industrial production and the unemployment rate. There's more in the paper, but the key message here is that in fact, flexible exchange rates do not seem to have any insulating properties to these external shocks, you know, compared to the peg. So that's potentially a puzzle, and kind of that's where the paper really sets out. So I'll just, you know, offer some of my comments on this empirical part first, and maybe just comments and questions essentially. So the exchange rate is meant to be a shock absorber, but what you actually see in the data is that doesn't move that much, right? So that's part of the puzzle. Now, the authors interpret this through the lens of an endogenous monetary policy response in the floating rate countries, right? So floating rate countries, you know, they argue increase interest rates. But what you actually see also in the impulse responses, so I don't have this on my slide, but you see this in the paper, is that interest rates actually in the floating regimes do not move that much, and arguably they're not even statistically significant. So compared to what you see in the neighbors with a peg, right? So there you see interest rates responding as you would expect following a contractionary monetary policy shock in the euro area. And obviously this response is both sizable and persistent, which is not something that you see in the impulse responses for the floaters. So that, to some extent, in my view, could be somewhat of a, could sort of be contradictory to what the kind of main interpretation in the paper offers, but it's just one point. So is the kind of relates to this issue of whether these shocks are actually large enough to meaningfully affect even the exchange rates, or could there be some, wedges in the interest parity conditions, some other forces that prevent the exchange rates from moving necessarily. So it'd be nice to see, for example, what happens to capital flows. That could be a nice addition to kind of dig into the channel further. Relatedly, I think it could be informative to look within certain countries and exploit sort of time series variation together with some changes in policy. For example, look at potential regime switchers before and after they switched. So Hungary, before and after a large exchange rate shock, for example. So Hungary in 2008 is a good example. Can you isolate a large exchange rate movement there? And in fact, in 2008, the forint depreciated by around 28% against the euro. So, that's a country that's in the sample. It'd be nice to see how it responds before and after, just whether you can essentially isolate this exchange rate movement to say more about the mechanism. Okay, and so more generally, it's related to this point that the authors say that, this is a homogeneous pool of countries. And in fact, it is quite, these countries are similar along a range of dimensions. They're all in Europe. They have free trade with the Eurozone, but they're still different. They choose their monetary policy regimes endogenously. So potentially there's some issues there, right? So looking at capital flows, looking at deviations potentially in these interest rate parity conditions, whether that could potentially explain some of what we see. Okay, the second part of the paper offers a model. So here I think, that's very, also very convincing and interesting. Basically to interpret the findings through the lens of a standard open economy new Keynesian model with the following two key ingredients. So one is dominant currency pricing, which is very prominent international these days. And the second one is intermediate imported inputs in production. So both are key to generate the key result. And here's the main finding, which we've just seen before. Again, you have the pegged neighbors on the left-hand side and the floating neighbors on the right-hand side. And the fact that stands out is that if you look at the countries that target inflation, right? So with inflation targeting the floaters, their response is indistinguishable from the pegged regimes, right? And this is kind of the key point, which is that once you have a contractionary monetary policy shock in the euro area, the floaters see imported inflation rising, and because of imported inflation rising, and because they target inflation, they are forced to essentially increase their interest rate, which is this dotted black line in the lower panel, and therefore see a similar contraction in output as the pegged regime. Whereas if the floaters were not to target inflation as much, they wouldn't care as much about imported inflation. They could potentially increase interest rates less, or maybe not even increase them at all. So that's kind of the main interpretation that the paper offers. So here just some couple of comments again and questions. So the lack of output insulation in according to kind of the paper is that it's really a policy choice, right? And so on a semantic level, that's very interesting in general, but on a semantic level, that's maybe a bit, this is a tiny point, but that's also interesting because if you look at our standard intuition, we don't actually think about these endogenous responses separately, right? So in the Mundell-Fleming intuition, it's kind of abstracting from what the policy regime is targeting, whether it's targeting inflation or the output gap. We see this intuition kind of go through independently. So whether that's really a puzzle or not, is this maybe just an addition to the models? It's an enrichment resulted from enriching the setting and thinking about targeting inflation versus the output gap explicitly. But clearly, insulation requires the willingness of the monetary authority to tolerate an increase in inflation. And That's because divine coincidence breaks down in the setting due to the fact that you have dominant currency pricing, right? So you have a real rigidity in here as opposed to a standard setting, and therefore stabilizing inflation versus the output gap, there's a difference here rather than a coincidence, right? So this goes back to, again, another long-standing issue, maybe from a normative angle, whether the costs of stabilizing, the costs of inflation are larger than the costs of business cycles. And Nakamura has a recent paper of co-authors on this. So the reason for the lack of insulation is imported inflation, as I already mentioned, and it's the desire to contain it. So this, in principle, and this is just another suggestion, could be a testable prediction of the theory, which the authors could take up, right? So you could look at countries that are in the sample, but certain ones that are more integrated into global value chains versus others. So certain ones are more open than others. And so if that's true, so for example, you look at the Baltics, Lithuania, these countries are more open than, let's say, Norway, then potentially these countries should also be more exposed to this insulation puzzle. So this is something that you could test across time and as well as across these countries. Okay, so just to wrap up, I think this is very exciting work with some really intriguing findings. I'm very sympathetic, obviously, to the larger literature and this paper. So obviously there's a host of other explanations that could, help explain what we see. So as I already alluded to, there could be capital flows, there could be wedges in the international interest rate parity conditions that just mean that exchange rates don't move that much, other than because there is a monetary policy response. There could also be, if you just look at monetary policy responses, there could be other tools that monetary policy is using rather than just interest rates, right? So certain countries use Forex interventions on a regular basis to stabilize their currency. So that could be going on. And obviously, this goes back to the larger issue that not all these countries are quite homogeneous, even though they are similar. Right, so you could, in the spirit of what has already been done, the authors look at a host of shocks, which I think is great, using these protection methods, but you could also add other shocks. For example, the QE shock from Altavilla, again, using these Jordan methods. QE actually, as opposed to the other shocks, had a strong impact on the euro, which is different from what QE did in the US, where it didn't have much of an impact on the currency. QE in the euro area did have a strong impact on the euro. So potentially that's interesting, be interesting to see how that kind of fits into the theory, where they confirm some findings and lend support to the theory. And perhaps, as I said already, it's worth looking into direct evidence on the channel. So one way that I could think about this is, or I would think about this is, test if the insulation puzzle is stronger in open economies. So for example, Poland has a higher imports to GDP ratio than Norway, and both are in the sample, right? 50 versus 35%. If so, then, this could be a way to test the mechanism. Okay, thank you.
Thank you very much, Alexander, for your comments. Unfortunately, we don't have much time for the questions. So if we have questions from the panelists, we can take one. Okay, if there are no questions, please ask them in Q&A, and Gernot will be able to respond to them in writing.
Thanks, Alexander. Thanks. Great comments. Thank you.
Thank you very much, both. Now we proceed to the next paper. Let's see the poll results. And the question was, the statement was the rise of the short-term corporate debt restricts the effectiveness of monetary policy. And we see that most of the attendees somewhat agree with the statement. And let's see what the research says about this. And I am inviting Matthias Meyer from University of Mannheim to tell us more about this nexus between short-term corporate debt and effectiveness of monetary policy. Matthias, you have around 15 minutes for your presentation.
Perfect. Thanks a lot to the organizers for putting my paper on this excellent schedule. Maybe shortly on the questions. So our results suggest that more short-term debt leads to larger effectiveness of monetary policy, but the trend is the other way around. There's more long-term debt over time. Okay, now let me motivate our project with a very simple example. Suppose there are two firms in the economy, and you're wondering which of the two firms is more responsive to changes in monetary policy. And let the first firm have high leverage and the other firm have low leverage? Now, this is a question that has been addressed widely. There is a large amount of theory, large amount of evidence with the latest, one of the latest contributions by Ochinel and Renberry suggesting that a low leverage firm responds more strongly. Instead, consider the case in which the two firms differ in their debt maturity. Suppose one firm has a high share of their debt maturing in the period when monetary policy changes, while the other firm has a low share of its debt maturing. Now, intuitively, having a low share of debt maturing insulates or, well, ensures the firms against changes in monetary policy. And potentially, the level or the amount of debt is less important than its maturity for understanding the transmission of monetary policy. Now, this is a question which has not been addressed in theory and in evidence, and that's the gap we try to close with. So at this stage, you may wonder whether empirically differences in debt maturity across firms are large at all. So this is a histogram based on CompuStat data. So you see, if we just focus on the first and the last bar, the first bar shows us that about 45% of the firms have a small fraction, less than 10% of the debt maturing in a given quarter, while the last bar shows us that for about 10% of the firms, almost all debt matures. And there's a large spread in between. So there are large differences in the cross-section of firms and how much of their debt matures in a given quarter. Our main contribution in this project is to show that corporate debt maturity does indeed matter for monetary policy. And we come to this conclusion by providing novel empirical evidence and by developing a model. So empirically, we show that firm investment responds more strongly to changes in monetary policy in periods in which a higher fraction of the firm-specific debt matures. Quantitatively, in response to one standard deviation monetary policy shock, the firm-specific capital response is 1% larger for firms with 10 percentage point more debt maturing. So we argue that the magnitudes here are large. Then we want to rationalize the evidence through a model and try to understand its aggregate implications. So the model is a New Keynesian model populated by heterogeneous firms which choose their debt maturity. And there are three channels in this model that explain the empirical evidence. There's a rollover risk channel, a debt overhang channel, and a Fisherian debt deflation channel. And in this model, debt maturity shapes the aggregate effectiveness of monetary policy. Just shortly on the related literature, so there are various, there is a large amount of prior work that we built upon. This project is also related to recent ongoing work by Alex Rodniansky. And the overall, I mean, the contribution here is really to study the interaction between monetary policy and heterogeneous corporate debt maturity, which is novel compared to this literature. Okay, let me in the following present you the empirical evidence and then introduce the model. So we are interested in understanding how the investment response to monetary policy is shaped by corporate debt maturity. How do we do this? We combine detailed bond level data from the FISD, which tells us the type of bond, the maturity, the issuance date, the volumes, etc., with quarterly balance sheet data from the US. In our sample of bond issuing firms, bonds are the primary source of external finance. Also, it's important to keep in mind that bonds, on average, are pretty long-term. The average maturity at issuance is 8 years. In our empirical analysis, at least as a baseline, we exclude non-callable bonds in order to mitigate potential endogeneity issues. So by excluding non-callable bonds, the average for most bonds remain until maturity. So there's a large time gap between issuance and maturity. A key empirical object in our analysis is this maturing bond share, script M, which is the fraction of bonds of firm I in quarter T maturing over the stock of debt of the same firm at the end of the preceding quarter. And we use that maturing bond share in the following set of panel local projections in which we regress log differences of the firm-specific capital stock on the interaction between monetary policy shocks. This is a high frequency identified series of monetary policy shock with the maturing bond share script M. And we also account for firm fixed effect and sector time fixed effects. Now, the key object of interest are these beta H coefficients, which capture by how much more does capital respond to monetary policy shocks when the maturing bond share of a firm is particularly high. And in the following, I will show you the beta H. So the blue line here is the point estimate of the beta H, and the shaded area are the 95% confidence bands. Let's focus on, and overall, beta H is significantly different from 0 in between 1 and 3 years after the shock. Let's focus on the response 8 quarters after the shock. And let me try to interpret the magnitude. So 8 quarters after the shock, what does this point here mean? This is a minus 1.1%. This tells us that in response to 1 standard deviation shock, 1 standard deviation monetary policy shock, 10 percentage points larger share of bonds maturing leads to a 1.1% lower capital stock. And together with an investment capital ratio of 10%, that would imply about 11% lower investment. Now, just shortly, there are a number of potential threats to identification, which we are careful to address, to name and to address. And I don't have time to go into the detail, but we address a number of potential threats to identification and find our results to be extremely robust against them. And we have a couple of further empirical results, a placebo exercise studying the interaction with leverage, maturity, distance to default, etc. But let me now move on to the model. So as I said before, we develop a new Keynesian model populated by heterogeneous firms subject to financial frictions and which choose their debt maturity. And in the interest of time, I will give you a very high-level overview of the model and highlight the main mechanisms. But first, let me try to motivate why we need a model. So the empirical evidence that I've presented before addresses cross-sectional questions. So in particular, it tells us how cross-sectional differences in the investment elasticity to monetary policy shocks can be explained by differences in the maturing debt share across firms. So the first thing, the first question the model is useful for is how can we rationalize the empirical evidence and what are the underlying theoretical transmission channels? But then we don't want to stop there. Ultimately, we are most interested in a macroeconomic question, which is how does that maturity channel shape the aggregate effectiveness of monetary policy? So through the lens of the model, there's a feedback between microeconomic heterogeneity and aggregate responses. And the model also has potential implications for time varying effectiveness of monetary policy when the debt maturity distribution changes over time, which it does. Now, what needs to be in a model to address our empirical evidence? So the model better have heterogeneous firms. There should be financial frictions to break Modigliani Miller. We want debt maturity to be endogenous, and we want to have a role for monetary policy. How do we put these things into the model? For heterogeneity, we follow the standard approach in the related literature. We assume ex ante identical firms who draw idiosyncratic productivity shocks and idiosyncratic capital quality shocks. In the model, firms face financial frictions, which come in the form of limited liability and default, which is costly, meaning that the fraction of the firm's value is lost to the creditor when the firm defaults. The firm can choose an optimal financing mix between long-term debt, short-term debt, and equity. And the relevant trade-offs between these three instruments are the following. Debt issuance cost makes long-term debt more attractive. You need to issue that less frequently, and therefore you save on debt issuance cost. But at the same time, there's a debt overhang problem in the model. Firms can't commit to repay, and which makes long-term debt more costly. On the other side, between debt and equity, debt is favored for the tax advantage of debt, but too much debt, well, more debt raises the risk of default, which favors equity. Ultimately, the model generates rich heterogeneity and share of maturing debt script M across firms. And finally, we close the model with in parentheses new Keynesian block. So there will be retail firms subject to sticky prices, and there is a Taylor rule which describes monetary policy. The model is calibrated primarily to match first moments in firm level data. But I want to emphasize that the model does a pretty reasonable job in matching patterns of second moments in the data. So we look at the cross-sectional dispersion, untargeted patterns, that is to say. So we look at the cross-sectional dispersion and debt maturity, leverage, default risk, but we also look at the conditional distribution, conditioning on firm size and age of these objects, and we find that the model explains a good amount of cross-sectional differences. Now, in the steady state of this calibrated model, there's an important correlation, and this correlation is important to understand the transmission of monetary policy. So there is a correlation between size, default risk, and the share of maturing debt. And in particular, smaller firms have higher default risk, and they have higher shares of maturing debt. Okay, they have higher shares of maturing debt partly because they have higher default risk, and therefore they react more strongly to changes in monetary policy. Let me be a bit more explicit about why they respond more strongly to why firms with a high maturing debt share script M respond more strongly to changes in monetary policy. Imagine a monetary tightening. Now, monetary tightening, there are three channels for this to affect firms differentially and associate with differences in script M. So firms with a high share of maturing debt will be more affected by a rollover risk channel, by which we really mean a cash flow shock. Okay, so if firms have to roll over more debt and financing costs increase in response to monetary policy, then this is really acts like a shock to their cash flow, which ultimately increases their refinancing costs overall, which lowers their investment. Second, that overhang. When in response to contractionary monetary policy, less new debt will be issued, which means the fraction of outstanding long-term legacy debt over total debt increases, which raises the debt overhang problem in the model, which ultimately raises default risk. And now in the model, firms that already have a higher initial debt overhang problem, that have higher initial default risk, for those firms, default risk will increase by more. And that's what we mean by the debt overhang channel.
Matthias, you have 1 minute left.
Yeah. And then finally, there is a Fisherian debt deflation channel, which amplifies rollover risk and rollover risk and debt overhang, and it operates in the model through the presence of nominal debt. We have replicated the empirical panel local projection on simulated data from the model. This is still somewhat work in progress, but overall the pattern is what we see in the data. So we see a significant difference. Firms with higher maturing debt share respond more strongly to contraction and monetary policy shocks. All right, let me use the last minute to conclude. The main conclusion is debt maturity matters for monetary policy. We come to this conclusion by empirically showing that firms are more responsive to monetary policy when a higher fraction of the debt matures, and we rationalize this finding through a heterogeneous firm model. What is still work in progress is to quantitatively decompose these different channels, is to study the aggregate effectiveness of monetary policy, and to study implications for time varying effectiveness. And on the last point, just a little teaser why we think that's interesting. This is the average and median fraction of debt maturing over time. And as you can see, from the mid-90s until today, this has been steeply declining. Okay, so in other words, there has been more long-term debt, or the debt maturity of long-term debt has lengthened. And we want to understand what implications that may have for monetary policy through the lens of our model. Thanks.
Great, thanks a lot. Now I'm inviting Walker Ray from London School of Economics to share his comments on the paper.
Great, thanks so much. Can you see my slides and hear me and everything?
Yes.
Cool. Okay, great. So thanks so much for inviting me to the conference and to discuss this very interesting paper. I learned a lot from it. It's quite dense. I don't think Matthias really did justice to just quite how big this model is that they're introducing here. So I'll do my best to kind of summarize these things, but I'll be very cognizant of the time as well. So just to reiterate, the big research question here is how the transmission of monetary policy, in particular to firm investment, is going to depend on the maturity structure of corporate debt. I think there's a lot of a priori reasons why we think this might matter. On the one hand, firms that have a lot of debt that's going to be coming due are going to be particularly sensitive to changes in interest rates if they have to issue additional debt. On the other hand, firms with a lot of outstanding long-term debt, fluctuations in interest rates are going to potentially lead to a lot of different decisions about the decision to default and the sensitivity to fluctuations in credit spreads. And more generally, we of course think that to the extent monetary policy is moving around inflation, we expect this to have a big effect on how firms treat their debt to the extent that it's changing the real value of the debt that they have outstanding. The paper presents some novel empirical evidence. In particular, they find that firms with a larger share of maturing debt, firms that are rolling over more debt today, are going to react more strongly to a contemporaneous monetary policy shock. And I think, as Matthias did a good job of explaining, we really don't have a lot of theoretical evidence, theoretical models to understand this type of interaction. And so what I view as kind of the big contribution of this paper is they introduce a quantitatively realistic model that models kind of a realistic set of heterogeneous firms who choose they choose the maturity structure of their debt to finance their capital expenditures, facing realistic financial frictions, realistic default probabilities, and they embed this in a new Keynesian type style macro model. I view this so first of all, I should just say this is part of kind of a broader research agenda that I think that the set of these co-authors have been undertaking in recent years, and is part of kind of this new burgeoning literature, in particular on embedding firm heterogeneity in new Keynesian models. There's, I think, very few papers that are doing this right now. I view it kind of analogous to the also relatively recent but slightly more robust literature that these days is trying to embed household heterogeneity into new Keynesian models. I've just, kind of some of the main recent seminal papers that do this. So I think of, analogous to introducing kind of household heterogeneity, idiosyncratic labor market income risk. This model and related models are going to introduce firm heterogeneity, idiosyncratic capital risk that these firms face. So not going to be able to summarize the model in enough detail, but kind of the key features of the model that I view here are going to be the introduction of these heterogeneous production firms. These firms produce using capital and labor and maximize shareholder value. And the key is that they need to finance capital, which they do by issuing either equity, short-term debt, or long-term debt. And this is a choice that the firms make, and they make this choice optimally. On the one hand, they're going to favor debt relative to equity because it gives them a tax advantage. But of course, this introduces the possibility that the firm might face costly default on their outstanding debt. And then in terms of long-term versus short-term debt, firms are going to face issuance costs. Issuing debt at any given period is going to be costly. And so because long-term debt does not need to be rolled over more frequently, that's going to give firms a reason to favor long-term debt, all else equal, over short-term debt. And then there is going to be default in this model due to limited liability. And in particular, the model here is going to add what they call idiosyncratic firm-specific capital quality shocks, which are going to affect firms' earnings and are going to be uninsurable. What this means, analogously to the heterogeneous agent models, when they put the heterogeneity on the household side here, is that this heterogeneity really is going to actually matter for these firms. And it's going to be necessary quantitatively, I think, because otherwise models like this are not going to be able to generate a realistic default risk across a large cross-section of firms. And then so just intuitively, if there's low enough realizations of these capital quality shocks, the firm is going to have a negative discounted value, along with limited liabilities, means the shareholders are going to optimally choose for the firm to just default. And this default threshold is going to depend not only on firms' choices that lead to different levels of outstanding debt and assets that they hold, it also is going to depend on the aggregate state of the model, in particular inflation, because it really is this real discounted value of cash flows that's going to matter. Of course, in equilibrium, prices of debt are going to reflect this default probability. So the key financial friction that's going to make this kind of kick in is that firms only care about, of course, the maximizing shareholder value. In particular, they don't care about creditors who are going to hold outstanding long-term debt, and they face a limited commitment problem. They're not going to be able to commit to future packs of actions. And so in particular, so if we can think about the intuition of what this means, if a firm issues more debt, of course, this increases the probability that they're going to be defaulting. And again, creditors know this and need to be compensated for this, so bond prices are going to fall. This is going to lower the firm's ability to raise revenue in the bond market. Of course, this is internalized by the firm. The friction here, though, is that also this is lowering the value of outstanding debt that creditors currently are holding, and this is not going to be internalized by the firm. Firm only is maximizing shareholder value, does not take into account this externality that they're placing on creditors who hold outstanding debt. And then, as Matthias was saying, this gets embedded in a kind of a full-blown new Keynesian style model. This is kind of a criminally simplified version of everything that they add in. The paper it's quite complex. There's a lot of details here, but basically, the way I think of this is basically add a bunch of other different agents to basically get us, in addition to these production firms, as close as possible to what looks like as roughly kind of a standard new Keynesian style model. But this is going to be a model, as I said, in which the heterogeneity actually matters. And so in particular, this is going to be a model with aggregate risk that also has a time varying distribution of firms. And so from a solution perspective, this introduces the issue that, you know, the distribution of firms is in fact a state variable in solving this model, which means that the only way to solve this model is, one, do it numerically, and two, we're going to have to make some approximations. First, solve the model when we first think about just fully shutting down aggregate risk, because we do want to maintain and solve for this model when there's actually heterogeneity in the distribution of firms. And then additionally, solve the model linearizing in terms of the aggregate variables, because we still want to be able to say something about monetary policy shocks and how output and inflation respond. So my view of this kind of simplified way of monetary policy working in this model, basically monetary policy is going to have effects on bond prices through two channels. The usual one, which changes the discount rate, and then an additional one, it's going to be through changes in default probability. And so why would firms potentially respond differentially based on the amount of outstanding debt that they hold? So let's think about a firm that has issued a lot of long-term debt that's currently outstanding, and issues less short-term debt. So on the one hand, they're going to face less rollover risk. There's less debt maturing today. This firm has small borrowing needs, so all else equal, they're more insured against changes in bond prices due to monetary policy, and therefore are less responsive. On the other hand, there's this debt overhang channel where if a firm has a large amount of outstanding debt, all else equal, this firm is going to be more exposed to fluctuations in default risk, are going to be less insured against changes in credit spreads, and hence this type of firm would be more responsive to changes in monetary policy. And then the numerical results from the calibrated model, the authors find that firms with the larger share of maturing, that is short-term debt, are going to respond more strongly to monetary policy, which replicates the empirical results in the first half of the paper.
Walker, you have 1 minute left. I'm sorry.
So let me quickly have a few comments here. I think basically the main result here is being driven by, it's not like the maturity structure per se that matters or that only matters. It's really this kind of endogenous sorting of the type of firms that issue short-term versus long-term debt. And so in particular, my understanding of these results is that in equilibrium, risky firms can't really issue long-term debt and they have to rely on short-term debt. On the other hand, firms that do issue long-term debt are less risky. And so for monetary, at least for small monetary policy shocks, they're not really that susceptible to fluctuations in credit spreads. And so this kind of rollover effect dominates. What I would like to see maybe a little bit more in the paper is kind of maybe rationalizing this with other type of results that we've seen in the literature, kind of two closely related papers. For instance, Gomez et al. Finds that in a model with long-term debt, monetary policy shocks have larger effects, but they don't have asymmetry. They don't have heterogeneous firms. Firms here are symmetric. On the other hand, Ottanello-Winberry recently find that firms with a high distance default are the most responsive to monetary policy, but their model doesn't feature any kind of maturity choice. So, maybe it's asking a lot, but I think this full model that the authors present could maybe rationalize these kind of contradictory results. And then just the last thing I want to say is that in the 1 minute I have left here, natural question to me would be to use this model to think about how unconventional policy like large-scale asset purchases work. Unfortunately, and this is not really a critique of this paper in particular, but the way that we have to solve these models abstracts away from risk premia. The model is solved as if all asset prices are being determined by risk-neutral investors, and so any type of monetary policy, such as large-scale asset purchases that work through changing risk premia or term premia, are going to be abstracted away from. But let me just give a little hypothesis of why I think this is still a fruitful area to work in. If I understand, understanding the results through the way I think about them, long-term debt here is largely issued by firms that face less credit risk, and so I expect that credit risk premia should be small here. And so to the extent that large-scale asset purchases work through reducing term premia as risk-free treasury term premia, I therefore expect a pretty strong pass-through to long-term corporate borrowing rates. But on the other hand, if instead long-term borrowing rates are dominated by credit risk premia, perhaps the effectiveness of LSAPs might be significantly more muted. So I think this is not to say that the paper needs to do something like this, but I find it a natural question to ask, and we're still maybe not there yet in terms of how we deal with these big heterogeneous models to answer those questions. So I know I'm over time, so let me just conclude. I learned a lot from this paper, and I'm really looking forward to seeing the finished product. So thank you.
Yeah, many thanks, Walker, for your careful read of the paper. Many thanks for all participants of this session. We have to move to the next session. So I wish you a productive discussions today. Please use chat and Q&As to follow up with the authors if you have some additional questions. Thanks a lot.
Thanks a lot, Walker.
All right, hello everybody. This is the next session on climate transition and monetary policy. We have two very interesting papers, one dealing with the expectations channel of monetary policy, of climate change and its implication for monetary policy. We've seen how important expectations are in setting and the transmission of monetary policy, and the second deals with the costs of transition. So the rules are as before. The presentation takes about 15 minutes, the discussion 10, and time permitting, we're going to have a Q&A of about 5 minutes. The first speaker is Rafael Schirle from the Federal Reserve Bank of Cleveland, who's going to talk about the expectations channel of climate change and its implications for monetary policy. Rafael, the floor is yours.
Hi, thank you very much, Linnea. Let me share my slides here. I'm making them big screen, so hopefully this works. Can you see them? Right, I can't hear anyone, so I go back to regular screen. Can you see me? Hello? Okay, I assume you can hear me.
We can hear you, but we can't see the slides yet.
Okay. Let me see again. Why does this keep coming up? Okay. All right. Can you see my slides now? And I'm sorry, this poll keeps coming up. I'll just click this. Okay. All right. So, okay. So if the slides don't turn, please tell me. So I'm going to talk about expectations channel of climate change, implications for monetary policy. which is joint work with Alex Dietrich and Gernot Müller. So thanks so much for putting this on the program. And the usual disclaimer applies. I've just turned the slide. And what motivates us here is really this emerging consensus that climate change is a key challenge for monetary policy. As Lael Brainerd on the other side of the Atlantic has put it, saying it is vital for monetary policymakers to understand the nature of climate disturbances to the economy, as well as their breadth and persistence in order to respond effectively. But also Christine Lagarde has very forcefully said that she wants to explore every avenue available in order to combat climate change. So far, much of the debate has really been about the physical phenomenon of climate change. So on the one hand, asking this question if climate change hazards pose a threat to financial stability, or on the other hand, so asking the question if monetary policy instruments can actually be used to combat climate change. What we do in this paper is we look at expectations of climate change and how they influence economic activity today, thereby making the case that if that's the case, they matter for monetary policy today. So why expectations of climate change? So there's good reasons to focus on them. Take a look at these two figures. The left panel shows you the actual costs of natural disasters over time, while the right panel shows you an increased media focus on topics of climate change across different media. So both of them are very likely to affect expectations on climate change. Expectations are a key channel in most of our, particularly our policy models. In fact, I think that climate change is actually the elephant in the room when it comes to the relationship between climate change. These expectations are the elephant in the room when it comes to the relation between climate change and monetary policy. Just to show this in a figure, which is I think worth 1,000 words, is the debate is either asking whether monetary policy can affect climate change, and sort of the answer I think is still sort of not fully out there, but probably not very much. But if there's also the reverse question, if climate change risks matter for the assessment of financial stability risk, and the answer is probably yes in some way, but it's complicated. And so we are adding to this is really the climate change and the conventional non-regulatory way of monetary policy understanding matters via an expectations channel for monetary policy. And so we argue in this paper this is a quantitatively potentially relevant channel. Just a very brief overview, what we find is really we use a survey of US consumers and their climate change expectations. They expect a negligible growth impact, but a very large probability of large natural disasters in the coming 12 months. And we find some evidence in the survey that this is tied to salience effects, but potentially also policy communication. In a model with rare disasters, we find that climate change disaster expectation can have a very large effect on the natural rate, so mattering for monetary policy. In particular, when monetary policy cannot accommodate, then this gets really bad. So what do we do in the survey? Well, we extend the Federal Reserve Bank of Cleveland daily consumer tracking survey with probably even more respondents by now. And we adjust weights and etc. to be accurate in terms of sampling. We include not only the regular questions on demographics, expectations, media use, but we add specific questions on the effects of climate change. First, asking about the expected distribution of GDP growth, very much similar to the question you saw on economic damages, both linked to climate change and natural disasters, as well as questions on the tail risk probability of a natural disaster. And then we add some information treatments, which I will all show you. One thing I want to make also clear is that we asked people a probability literacy question, where we give them some very simple question. You've drawn 14 balls that have one color out of 70 balls. What's the probability if you sample with replacement that the next draw is going to have the same color? And so this allows us to differentiate into high and low probability literacy question, numeracy. And about like 70% of people sort of get this question very precisely right. It's a little so. Anyway, let me start with the first question, just to give you a taste of the question. So we ask about the probability of large natural disasters. We ask them the following: as a result of climate change, the risk of natural disasters is likely to increase. The economic damage of such disasters may be sizable. Considering the next 12 months, what do you think is the probability of a large disaster causing damage of about 5% of GDP? And then people can write in their answer. And in a similar fashion, we ask about GDP growth and economic damages due to climate change over the next 12 months. And we complement this with the 4 treatments that I mentioned. The first being a treatment representing an excerpt from the USA Today, summarizing the hurricane season or wildfires that were very prominent last year and linking that to global warming. Then we give 2 historical information treatments which either quantify the disaster size or the frequency of disasters. So this is the second and the fourth. And then third, we also use a policy statement from Lagarde, which is essentially the one I gave you in the beginning. So what do we find? So let's look at the first question regarding the expected GDP growth impact over the next 12 months. So people give their answers distributed over the different bins here. And we show you the answers here for all respondents in blue, as well as the high probability literacy guys, so the guys that get this probability question right. And you see that, if you average this out, sort of end up with a number somewhere here, and in fact, that adds up to about 0.6% percentage point difference in the growth rate. But there's sizable disagreement here. And we probably underestimate this even by having bins that ended 2 percentage points or more. So that's certainly there. But we do see that the high probability literacy guys don't have a markedly different pattern from the all respondents guys. So this gives us some confidence that understanding probability is not driving these results. Next, we ask about economic damages due to climate change over the next 12 months. And there again, we find a wide distribution and similar patterns for all respondents or the high probability literacy guys. The average is about 1.5% of GDP. So this is a large number. And in particular, you also see a heavy tail here that about 10% of respondents expect losses of more than 5% in the next 12 months. And the third question is about the probability of rare natural disasters. So here I'm showing you for now the distribution and various conditions. So the red solid line represents all respondents, and you see that the mode across the different conditions here is always at around 10–12%. So that's a fairly large number, but you see there is a very large tail, or a lot of mass actually, to the right, irrespective of what you look at. And you also see that some of the treatments, and I give you some more numbers there, tend to work out in the direction, mostly by shifting mass here, but also a little bit here on the tails. So just as a first check on these numbers, so are they large? That's usually a question we get. I try to argue that's probably not measurement error, in the sense that I get very similar responses for people who understand probabilities. And there's meaningful covariance with socioeconomic variables and people's reported economic behavior. And these answers are also intuitive in the sense that salience plays a large role. So personal experience, media usage, as well as some of these treatment effects, particularly the policy communication. So I try to show how these impact the beliefs. So first of all, as I've argued, there's no difference for the high probability literacy guys, just to show some numbers across the 3 questions. So the top panel is all respondents, the bottom panel is the high literacy guys, and basically the means and medians are statistically not significantly different from one another. Now there's variation with socioeconomic variables that's meaningful. For example, you can see that Republicans have lower disaster probability beliefs, versus Democrats have higher beliefs relative to independents. But also older people expect lower growth and lower damages, higher growth and lower damage effects of these climate change risks. So this is sort of consistent with one another. Now, in terms of behavior, that's sort of an important cross-check. People, as you can see from these 3 figures, but they're more in the paper, answering these different questions, like they eat no or less meat due to climate change, indeed have a meaningful response in the cross-correlation with their median disaster probability. So people who say, yes, I eat less meat, they also believe that the disaster probability is higher, versus when they say, no, I don't eat less meat. And this is consistent across like a plethora of questions. Then salience seems to play a role in the sense that we have zip codes, so we can identify experience of wildfires, flooding risk, very detailed geography, but also coding some other indicators, and they are associated with significantly higher percentage points of these probabilities. Media usage also plays an interesting role here. So if you don't watch a TV and station or you don't read a newspaper, then you have a 6.9 percentage point lower disaster probability than someone who's not in that group. And you can break this down by the different categories, so there's some additivity here. And finally, the information treatments have mostly significant effects. In the terms of the historical information, that brings down people's beliefs, as you might expect, but more so for telling them about the disaster size rather than the frequency. Confronting them with the news actually raises the probability of expecting a large disaster in the next year. And interestingly, the policy communication comes out very strongly. And here we use actually Lagarde, so we're not allowed or not able to use a US statement for public sensitivity, but even Lagarde speaking and has an effect on the US audience that ranges between 1.3 to almost 3 percentage point higher beliefs. So just to take stock here, the probability tends to be very large that climate change will lead to a large natural disaster in the next 12 years. Somewhat larger than a historical record, but these are subjective beliefs, right? That's what matters for our models. They can be tied meaningfully to the data, and at a deeper level, I think my discussant will talk about this, but there can be some explanation why people might actually be anticipating this correctly. So I don't know if I have time for a model. If I do, I will take 3 minutes here. So we have basically a variant of the New Keynesian model that we augment, or that features natural disasters with a probability that a disaster hits. And if that happens, fraction of capital lost is lost, and productivity growth drops temporarily before it comes back. So we can solve this model in analytical form under some simplifying assumptions, and then also the full model. I'll just jump to the results. This model is fairly standard. Under the simplifying assumption, it basically boils down to the Gali textbook model. And the two results, one is that the natural rate of interest is not only tied to the rate of preferences, as is usual, but also the probability and the magnitude mu of a natural disaster. And those enter negatively. So the more likely and the larger this expected disaster, the lower the natural rate. If you actually look at the inflation rate and the output gap, for after we specify a very general interest rate feedback rule responding to the natural rate or inflation in systematic ways, then we find that if you implement the natural rate, we get sort of the usual result that you can perfectly stabilize output and inflation. But as soon as you deviate by not focusing perfectly on the natural rate, but instead of inflation to some extent or to no extent, you incrementally aggravate the stabilization in the sense that the inflation reacts and the output gap also reacts. Okay, so just to put some numbers on this, and then I think I have to conclude, but please tell me otherwise. So if you calibrate the model to our survey probabilities of a rare disaster of some magnitude, or some distributional features across respondents, then you find that the natural rate of interest is about half of what you would get if you just don't allow any of these expectations about natural disasters. In fact, inflation is also lower. So this sort of just reinforces the result that I showed you in closed form. And I believe I have to conclude for time reasons. So I've argued that expectations regarding short-run economic impacts of climate change are small, though positive. But at the same time, the probability of a large natural disaster is at 12%. If we embed this in a New Keynesian model with rare disasters, we find that indeed these bad news lower the natural rate and thereby are directly relevant for monetary policy. And to conclude on a provocative note, again, this is my personal opinion, there is somewhat of a paradox of communication here that one has to think about very carefully. I'm not saying we shouldn't communicate, but if you are a policymaker and engage in the climate change debate, people may, as our information treatment shows, perceive this as some kind of bad news and actually get more pessimistic, which then makes your life harder as a policymaker. So you might want to be very careful about this. Okay, I'll stop here. Thank you very much.
Thank you, Rafael. Francois?
Thank you. Okay, can you see my slides on here?
Yes.
Okay. So thanks a lot for inviting me to discuss this very nice paper. So usually when we think about the effect of climate change, we think about the long run. And what's interesting in this paper is that it argues that there is a short-run effect of climate change, more precisely of expectations of natural disasters, because these expectations basically create uncertainty, negatively skewed uncertainty, which generates negative demand impulse. So you can think of this as a positive theory of why R star is low. It's like there is more uncertainty about negative shocks. So the policy implication, of course, is that you have lower R star, so central banks should accommodate this by reducing interest rates. And the nice way they reach this conclusion is by having these new survey results, which they feed into a standard DSG model. So what I want to talk about is 4 things. One is a suggestion to try to validate the mechanism empirically. And then I want to talk a little bit about the 2 pieces of the paper, the measurement of beliefs, and then the model which is used to to generate outcomes given the beliefs, right? And if I have time, I'll touch on the policy implication. So in terms of validating the mechanism, I think the story of the authors is basically that if there is more of this uncertainty about natural disasters, people are going to want to save more in risk-free assets, and they're going to also have more negative expectations about output and on inflation. And so I wonder if it's possible for them to test this directly at the individual level, right? Do the people who are actually more pessimistic about climate change, do they actually save more? So that's probably kind of hard to measure, but I don't know what data they have exactly. But something they can probably do easily is that do these people actually have low expectations for inflation and output? Because I suspect this survey is used to calculate the inflation expectations. So they probably have actually already the data on inflation expectations. So I would be really curious to see if there is actually a correlation, like the model would suggest, I think. The other angle, which I think could be used to test the mechanism, is to look across US regions, because, I mean, across the US, I guess Raphael lives in Cleveland. I live in Chicago. There are not too many natural disasters where we live. But it's very different if you live in Florida or in some parts of California. And so it's not just that the salience is different, that the actual risk people face is very different. And so I wonder if these relationships would be also different across regions. So in terms of the measurement of beliefs, so I was a little bit surprised by the results, to be honest, because so I think the key question is this one, right? They ask, what is the priority of a large disaster over the next year that causes damage of about 5% of GDP? And like Raphael said, the median response they get is 12%, which is fairly high, right? This is not a rare event in a sense. It's one every 10 years. But the thing is that 5% of GDP is really huge, right? Because Katrina is the largest disaster in the US history, at least over the past 40 years, I guess. Katrina destroyed 1.3% of GDP roughly. So you're asking the priority to have something 4 times bigger than Katrina, and you're saying it's much higher than the historical probability of Katrina, right? Just based on the sample we have. So I find this pessimistic, but I'm not sure, because of course things are changing, right? And the disaster risk is rising, and the cost of disaster is rising, like Raphael showed. So I would be curious to see what specialists think about this. Do specialists think that this is actually an overestimate or not? I don't know if it's possible to get a sense for that. I guess insurance companies probably have a sense, because these damage costs, of course, are just economic damages. They don't include lives. So then, the paper discusses in detail why people might be pessimistic, if indeed they are pessimistic, right? Which is the question I was asking of whether they are pessimistic or just a realist. So I think there are two things which I think strike me as plausible. One is that there is a problem of understanding these questions. 5% of GDP. I don't know that many people understand really what it means. Just as a personal anecdote, I was actually sampled once in the Michigan survey of consumers. Actually I found the questions pretty hard to answer, even though, I had just been through a FOMC briefing preparation, so I had seen the actual numbers. But it just hard, you're taking the survey, you may be driving at the same time, and they're asking these complex questions. So I think they try their best, but it's still a bit uncertain to me. The second question, which I think is perhaps more important, is that, it's not clear that this is a question that's interpreted about national risk for the US or local risk, right? I mean, do people think they're asking, is there a natural disaster in my area? I think, the phrasing of the question, I think, is fairly precise, but it's kind of natural to think that people think about their risk. I'll get back to that in a sec. So now going to the model. So I think what's interesting is, okay, I mean, we can dispute exactly the magnitude, right? But people have some beliefs about natural disasters and that could affect their economic choices, right? And the question is what are the mechanisms through which expectations of disasters are going to match, to map into outcomes, right? And so I think the paper is basically looking at this kind of standard savings channel, which are, I think, the ones that have been explored a bit in the literature. So the way I think about them is that, in a flex price model, when you have more risk, you're going to invest more if capital is not too risky or if the IS is low. So basically, in this case, you try to accumulate more savings to protect yourself. But if the IS is high or if capital is risky, you can get basically less investment because you don't want to invest in housing, for instance, that could be affected by a disaster, could be destroyed by a disaster. And then in a sticky price model, you have the kind of more conventional demand kind of argument that, if you have these negative expectations, they're going to lead to lower output and inflation if monetary policy cannot react, basically because people are trying to save into risk-free assets. And so you kind of need to accommodate this demand for risk-free assets. So otherwise, you're going to have less effective demand in the short run. So I think all this is completely fine. One question I just want to point out is that it's not completely obvious to me how you want to model natural disaster. In the US, usually you get a pretty good bounce back following a natural disaster, which suggests that, basically you destroy capital, like, when you have these hurricanes in the South, you destroy a bunch of capital, but usually people rebuild and then they kind of go back to trend more or less. So in that sense, I'm not sure that there's a productivity effect of a disaster in the US, but to be fair, if you look at hurricanes in, for instance, the small Caribbean islands, so the island states, you find very persistent effect of hurricanes. And so, you kind of have to think that productivity is affected in this case. But I think it's kind of an open question how we should model these things. And more generally, I think, you can think of alternative mechanisms through which the fear of natural disaster is going to affect the economy, right? So for instance, if you tell me that there's going to be a natural disaster next year, what am I going to do? Well, probably the first thing I'm going to think of doing is investing in adaptation against the disaster. So I could be buying a power generator or something like that, or one of these new F-150 Ford electric truck. But, of course, there are other mechanisms. You could say, okay, I'm going to buy insurance. I'm going to invest less in real estate, but perhaps more in risk-free assets, right? So there could be this kind of portfolio shift. But the thing that I think is more interesting and perhaps puzzling is that, if you tell me that there is more risk of natural disaster in Florida, I mean, how does this affect me living in Chicago? it's not obvious to me, I guess. It's not clear. I guess you could say I have to expect that there's going to be some effect on the overall economy, but I'm kind of tempted to say that it shouldn't affect me. So you should see effects only on people who are close to disaster zones. But you know, I mean, this is just a speculation. I think this is something that's kind of interesting to think about, to distinguish between people who are more or less exposed to disasters. And then on the policy implication, so I think there are two simple points, right? One point I think is that this paper is mostly, to me, about a trend effect, right? That we have more climate change risk, and so that's going to lead to a lower R-star, and I think that's completely right. And of course, there are lots of work on the policy implications of a low R-star, like how do you design the policy framework for it and so on. But in principle, you can kind of adjust to a trend change, right? I mean, this is, of course, the ALB creates complications, but in principle, you adjust the intercept in your Taylor rule, and that's it. Then there's a kind of cyclical aspect, which is, you know, if you think that there are fast changing beliefs, you know, then that's basically creating more demand shocks. And so there's a question of how do you respond to it? I mean, because it's a kind of standard demand shock, I think, you know, your usual policy rules should still do kind of okay. But I mean, it is an open question, I guess. It's going to depend, you know, on whether you think there are really a lot of high frequency changes in expectations, which I don't know. And then this paradox of communication that Raphael, you know, alluded to at the end, which I think is interesting, is this idea that, you know, if you start talking about climate change, basically you're going to foster bad expectations, which are going to make it perhaps harder to achieve your dual mandate. And I think it's a little bit more mixed than he says, because it's true, of course, that you can foster this bad expectation. But on the other hand, you know, if you think the expectations people have currently are too pessimistic, there is perhaps room to communicate, to improve the accuracy of the expectations, to make people slightly more optimistic, I guess. Because, I mean, at least I think, again, perhaps I'm wrong, but I think that the short run risks are objectively not super high, except in some places. So perhaps that's where policy might be actually not too constrained. Okay, so that was it. That was a great paper. Thank you very much.
Thank you, Francois. Do we have any questions from the panelists? Please raise your hand. If not, I have two questions actually, Raphael. So one is related to the question. I feel there's a little bit of anchoring and adjustment once we present the question with a number 5%. So people might think, well, maybe 5 might be the maximum. So I'm just going to say 1.5 or 2 or stuff like that. So there's these behavioral biases that are usually extremely salient in the way we frame the question. Also over the 12 months, right? So we basically give them a precise period of time over which we believe this might happen. And what's interesting, if you look at the poll we had, most people think that these changes are going to happen over the medium run and over the long run. Now, of course, this is our tendency probably to see this as a long run problem. It's not something that's going to hit us immediately, but this shows how important it is, I think, to frame the question or how framing the question might lead to a certain type of answer. And the second, I was thinking of some validation model for the expectation. So if you buy property on the coastal area, you have to pay usually more insurance. And I think there's a sort of a trade-off implied in that, how you can basically back out the probability understood by the buyer in terms of floods and stuff like that. In agriculture, is the same story, right? So if you're a large landowner, you're going to have to pay more insurance, but that's an economic trade-off which is very clear to you. You know how much you might lose against what your yield is. So if you're willing to pay that insurance, that already tells you what is the implied probability of a particular loss over a particular period of time. And I think this might be useful measures to check this.
Well, thank you so much. I guess I don't have time to respond, but first I really want to thank Francois for this very, very deep and thoughtful discussion. discussion. I think we could probably talk for an hour here about your points. We have some answers, some in the paper, obviously. You can see I don't have much time to talk, but thanks so much, and maybe we can connect at some point, and hopefully also in person. But thanks also for your suggestions, Minya, that they're great, and I think this is a totally open field. I think there's a lot we should probably ask and learn here. That's all I can respond in like these 10 seconds. I apologize. But yeah.
Great, thank you so much. So we can, we can also take some further questions if they're there in the Q&A. If not, let's move to the next paper, the rising cost of climate change evidence from the bond market. Michael Bauer from University of Hamburg will be presenting, and Johannes Ströbel from New York University will be the discussant. Michael, the floor is yours.
Thanks, Mia. So yeah, this is work with Glenn Rudebush, who I think is on the call, got up early for this 10-hour time shift with San Francisco. Thanks for putting this on the program, great conference. So climate change leads to damages that are very long lasting, many years, hundreds of years, probably in the future. And so how to discount these future damages to the present is incredibly important. So small changes in discount rates can really make a big difference when you're doing cost-benefit analysis of climate change. Okay, so we're thinking about discount rates here in this paper, both the level of discount rates and then the entire term structure are really important. And so there is a vast literature. Here's, I'm citing a few review articles on this that goes back several decades, but there really is a lot of disagreement still about what appropriate social discount rates are. And now with the Biden administration taking office, there's a new discussion about this issue with the revision of the social cost of carbon that they're undertaking. Okay, so there's two approaches really. One is more normative, using theoretical models, welfare analysis, and generally leads to pretty low social discount rates. And by contrast, more empirical approaches, what's called the descriptive approach of social discount rates, where you're really looking at financial markets. There, people have typically found higher rates of return. Nordhaus in particular uses a real rate of return of about 4% in a lot of his analysis. And if you survey experts, actually, the responses that are based on normative analysis tend to be lower than those responses based on positive analysis. According to this survey by my colleague Moritz Drupp here in Hamburg, and then several co-authors in the AEJ policy. So there's this kind of divergence between these approaches. So what we're going to do in this paper is we're going to use a descriptive approach. And so with an empirical framework, we're going to look at discount rates. And basically, we're going to take this emerging consensus from macro finance that the equilibrium rate of interest, or R star, has declined over the last several decades, and we're going to bring it into this analysis of discount rates. Now, theoretically, it's pretty straightforward to show that R star really is the fundamental anchor of all social discount rates, and in some sense is a level factor in this term structure. Now, we're doing this empirically using time series models for risk-free social discount rates. So basically, we're using treasury yields, we're subtracting out expected inflation, and we estimate long-run discount rates from these short-run real rate proxies that we have using these models. Of course, the problem in this entire literature is you cannot see the really long-run social discount rates. What you can see is short to medium-run real interest rates, but you can't see long-run real interest rates. And that's just one of many problems, but that's the one we're focusing on here. So we estimate a decline in R star by 1 to 2 percentage points, which is in line with other estimates in the macro finance literature. And this implies a similar downward shift in the entire term structure of social discount rates. And as a result, the social cost of carbon, that is one of the currently most pressing applications of social discounting, the social cost of carbon at least doubles according to a variety of different climate economy models that we look at. So with this analysis, we're finding lower descriptive discount rates, and in some sense bridging the gap between descriptive and normative analysis where there is this discrepancy I just laid out. Okay, so our results really strengthen the case for immediate strong climate mitigation policies. Now, there's basically two strands of literature this is most related to: the macro finance literature that finds lower R star, and the social discounting literature, which uses empirical models for the discount rate. But these models all almost all assume that there's a constant long run R star, and that's the assumption we're going to change, and we're going to bring some more sophisticated time series modeling to this problem. A word on the risk-free discount rates we're focusing on. They are appropriate for discounting risk-free payoffs that are either certain or uncorrelated with future growth, or you can also use them to discount certainty equivalent payoffs or risk-adjusted payoffs. If you really want to deal with risk, you kind of need to do this risk adjustment. That is orthogonal to what we're talking about in this paper. There's a lot of disagreement about what the so-called climate beta is and whether risk-adjusted discount rate should be higher or lower. Our points kind of go through whether you do or don't do a risk adjustment, because the risk-free social discount rates really are kind of the anchor around which any risk adjustment would have to happen. So we think these results have broad relevance. So our star, we define it as the long run mean of the short run real interest rate. Pretty simple trend concept here, stochastic trend in interest rates basically. And the basic conceptual framework is that a long run real interest rate here, YT maturity n, is really equal to R star and then plus average expected deviations from R star, and then some kind of convexity. Now, this leaves out the term premium effects, which is just necessary because you don't really observe long-lived assets. At least it is not very many of them, and we're not incorporating them in this analysis. So this is so the key point here is that R star affects all discount rates 1 for 1. And we're going to look at the empirical implications of that. Here's a few macro finance estimates in the literature. All of them find a decline in R star by, usually 1 to 2 or even more percentage points over the last couple of decades. And our little model and all of our models are within this range. But let me show you our main model. Very simple unobserved components model, time series model, where R star is a martingale. And specifically a random walk, and the cycle is a simple AR1. You can go more sophisticated, but you'll still find very similar results. Okay, so just a trend cycle model for real interest rates. For the real rate, we either use the 1 or the 10-year real interest rate, and to have some robustness for different time series. We use Bayesian estimation because that is necessary to estimate the long-run trend components of time series, to kind of discipline these long-run trends to not be jumping around, and that is a common approach in this literature. Okay, so we provide new estimates of R star, and then we can use this model to calculate long-run discount rates. Here are our estimates of R star, the blue line for the 1-year and the 10-year real interest rate. So the trend component of these interest rates, which as you can see in the left panel, where we're also showing a dashed line for an average of other estimates from the literature, is very much in line with previous results. Okay, the decline is a little higher for the 10-year rate. Okay, so what is the implication of this for social discount rates? We also have a couple other models. Let me skip this for the sake of time. Okay, so what we'll do is we'll use the information at 1990 and the information kind of now, and and calculate the implied term structure of discount rates. As said, we use the expectations hypothesis, like all other papers in this strand of the literature, to obtain long-run rates from these short rate dynamics. And we account for parameter uncertainty, which is kind of important. Uncertainty plays a pretty big role here in this business because it drives down long maturity discount rates because of the Weizmann effect or convexity effects, as fixed income people would call it. We want to constrain these discount rates to be non-negative. And we use an approach from some of our previous work, which is popular in the term structure literature, and this shadow rate specification. And we could have a whole discussion about this constraint, but basically this makes it conservative. If we did not impose this constraint, we would find even larger declines in discount rates, some of them turning negative, which of course then leads to really big social cost of carbon. Okay. So from these two models that I showed you the R-star estimates for a couple slides ago, these are the implied term structures of discount rates for 1990 and 2019. So they shift down kind of at the short end, pretty much 1-for-1 with R-star, which is shown as dashed lines here. At the longer end, because they get kind of compressed by the zero lower bound, the decline is a little bit less pronounced than in R-star. They're also all of these term structures are very strongly declining, much more so than kind of conventional stationary models that assume a fixed R-star because of this additional uncertainty about the long run mean. Basically, Weizmann effect gets amplified, convexity gets amplified because you have more uncertainty. Okay, but let me use last couple of minutes to show you implications for the social cost of carbon. The social cost of carbon is the discounted value of the discounted sum of future expected damages from an additional increase, an additional ton of CO2 emitted today. So here is just a formula for this present value with our long run discount rates here, depending on the horizon n. So you need a term structure of discount rates, obviously, and we'll use these two different term structures I just shown you, and we'll keep everything else fixed. So we'll use some very standard estimates of marginal damages from variants of the DICE model of Bill Nordhaus. We are using, I'll show you some results for very recent updated version of the DICE model that account for recent advances in climate science that where the results look quite a bit different, and in particular give you higher levels of the social cost of carbon than for the original model from Bill Nordhaus. But what's important for us is not the level of the social cost of carbon, but the change due to this lower R star. And this change here on this slide with way too many numbers, I apologize, is at least 100%, basically. Now, the social cost of carbon here shown for 1990 and 2019 at least doubles across these two different climate economy models in the bottom and the top panel, and across 6 different models for the social discount rate, which give you somewhat different term structures. I've only talked about the UC model so far. We have these other AR models that are a little bit closer with some other models in the literature, but still account for a shift in R star. Okay. So really large changes in the social cost of carbon. The levels could be taken with a grain of salt. We don't really are promoting one particular number. We're just saying we have to incorporate this long run trend when we're doing this kind of analysis. So macro finance shifts more generally matter for the economics of climate change and this decline in R star in particular. We think that in the policy discussions that are going on now, both the lower level and then of course also the declining term structure are important issues. Right now, the US has a pretty high constant social discount rate our results suggest a much lower level and a declining profile over time would be appropriate. I'm laying out some future directions for research here, but let me leave it at that and give over to Johannes Ströbel. Thank you.
Great, many thanks. Johannes?
All right, well, thanks everyone. Can you guys hear me?
We see you, we see the slides.
Perfect, great. Okay, so so I'm really happy to see that you know, a session on climate risk and you know how central banks should react to it, but also more broadly how financial markets should think about climate change and climate risk has made it on the program. You know, it's a topic I've thought about for a bunch of years now, and you know, it's really kind of fun and exciting to see sort of the increased attention, you know, everywhere on what I think is really a first order macro risk. So, you know, when you think about climate risk and how much you should invest today to avoid climate change in the future, you know, discount rates obviously play a central role, right? So, you know, some of the economic costs of climate change are already felt today. If you think about, say, wildfires in California last fall, or you think about hurricanes, think about droughts, etc. But, you know, as Michael has mentioned, some of will only materialize many decades into the future. And so evaluating how much you spend today to avoid these climate damages, you know, 40 or 50 years in the future, you need to do a cost-benefit analysis that incorporates the present value of these damages. And so, you know, as we all know, when you think about present values, the you know, the discount rates that you use are you know, are really central. Sorry, are really central to the you know, to the analysis. So this is from Bill Nordhaus. You know, he said, look, any consideration of the cost of meeting climate justice requires confronting one of the thorniest issues in all of climate change economics. How do we compare the present values? We really have to deal with discounting. And just to kind of give you a sense of the quantitative, you know, analyses, when you evaluate you know, an investment, say 50 years into the future, the difference between say a 1% and a 7% discount rate, that's roughly the range that people, you know, in say the US government use when they do these cost benefit analyses, you know, can be a factor of 10. Right, so you know, compounding really kicks in very, very quickly, and so you know, the difference of you know 1 or 1.5 percentage points in terms of the discount rate, you know, that's the order of magnitude that you know Michael and Glenn find in the time series can really have a large quantitative effect. So we know from finance that you know discount rates you know are you know, in the most simplistic way to think about them, are the combination of a risk-free rate and a risk premium. You know, and you know, we know that both the risk-free rate and the risk premium can differ over different horizons, right? And so that gives you term structures of both risk-free discount rate and risk-free premium. And then, in addition to that, you know, both the risk-free and the risk premium can, at all horizons, can vary over time. And so, what this paper does is it really focuses on trying to understand the, you know, the dynamics of the term structure of this first component, the risk-free discount rate, as we kind of go over longer horizons. So what does the paper do? It shows that this risk-free rate has fallen by about 1 percentage point, roughly speaking, over the last 30 years, and that it has largely fallen by this amount, not just you know, not just in the short run, but over all sort of horizons in that term structure. So here's the figure. Michael had it up too. I think this is really the central result, to see this decline in the, you know, in the long run risk-free rate, you know, which is sort of consistent with also, you know, and as they show in table 1, with also a large range of other models, other modeling approaches. I think that's important because I think, you know, as you know, as Michael's pointed out, when you're trying to get these discount rates from bond markets, you know, a difficulty is that bond markets usually don't go out that far. And so you can't really just look at, you know, the price of, say, you know, a 50-year zero coupon bond, and, you know, which would directly inform you about the risk-free rate over that horizon. You know, there's some term premium and, you know, and some inflation concerns in there too. But putting those aside, if you could observe the, you know, the price of a 50-year zero coupon bond every year, you could directly back it out. We don't observe that in, you know, almost all fixed income markets. You know, the UK has some really long run gilts that allows you to look out maybe up to 50 years, but certainly in the US you can't do that. So, you know, you basically have to put down a factor model somehow, you know, and And the authors do that here. They've worked with those models in the past, but it actually turns out, I think, given some of that what we've seen in this table 1 I just showed you, is that the exact specification of that factor model doesn't really dramatically drive the assumption. So what I said here, that I think it would be interesting to perhaps show robustness to other factor structures within your paper. I think it's also kind of reassuring to see that like other models and other estimates give similar declines. So here's another graph that you just saw that shows you this sort of but not just the overall like 1 percentage point decline on average, but also that shift in the entire term structure. Now, as Michael mentioned, it's actually very challenging to find finite but long run discount rates or assets to estimate these discount rates, but those do exist. So I've done some work in the past looking at housing markets where you sometimes have 100-year assets trading alongside infinite assets, and if you look at the price difference between these 100-year and infinite assets, what you get is a discount rate for a claim 100 years in the future that you can directly read off over these horizons. And so the results there are again pretty consistent. We find a discount rate of about 2.6% at 100 years for a risky asset, which obviously then gives you an upper bound for the type of risk-free rate that that the authors are looking at. And it's also consistent with a downward slope. Now, what's really kind of the central part in this paper to me, and what was something that I don't think others had looked at, is not only is it downward sloping, but you really have this declining level over time, and that leads to a higher valuation of future damage. So I think that's I think a very credible result. So I don't think there's much to quibble with, both because I think the specific analysis in the paper here is very well done, also because it kind of is in the ballpark of this decline of the existing of some of the existing literature that might have taken slightly different approaches, and also just because it is consistent with just the short rate declining dramatically over this horizon. And so you would expect whatever the model you write, when the short rate goes down, that should feature into this. So I think that the results are very credible, and I think the magnitude implications of this are large in terms of the higher social cost of carbon that you get out of a model when you reduce the discount rates. The question then is, what's the correct discount rate to use, right? And so I think Michael has sort of discussed that a lot of the ingredients that one needs to think about beyond this sort of risk-free rate and the term structure of the risk-free rate and the time series movements in the term structure of the risk-free rate. The other really important part is to think about the second component, the risk premium, right? And I think it's either both of these components are sort of important to understand. And as Michael's already pointed out, when you think about the risk premium, you need to figure out about risk loadings, right? Is investing in climate change abatement a risky asset, i.e. it pays off in good states of the world? Or is investing in climate change abatement a hedge against really bad realizations of states of the world? Now, you could think about both of these modeling approaches. So Bill Nordhaus is usually taking the first approach, right? He says, look, climate change is just a tax on consumption, right? And it's a byproduct of economic growth. And so climate change really only materializes in very good states of the world. And so as a result of that, it's a risky investment, has a high discount rate, and and the social cost of carbon is low. There's an alternative approach you can take, and Marty Weitzman and others have taken this approach, where you say, look, climate change is really an economic disaster in of itself. And I actually think Ralph's presentation we saw in the first half, we've kind of implicit in their modeling was that they think about climate change as sort of a big rare disaster style risk, where actually mitigating climate change damages pays off in bad states of the world, in high margin utility states of the world. That would imply a negative risk premium. And so these sort of term structure of risk-free rates that Michael and Glenn find would actually be an upper bound on the types of discount rates that you should be using when valuing, investments in climate change abatement. So I think, I think it's actually very helpful to kind of, have this sort of, thinking about the risk-free rate where we can go there, and then also thinking about the risk premium, putting them together, because as we saw, the impact of that on the social cost of carbon, talking about a factor of 2, factor of 3, factor of 4, that makes a dramatic difference in sort of, rulemaking and regulatory processes, and probably more so than some of the other parts that go into calculating the social cost of carbon estimates about damages, etc. So I think it's an important paper to provide useful insights into, one of the central elements in value and climate change abatements, and it looks like those investments have become more valuable over time. There's one thing that the paper doesn't directly say, but I think it's at least implying, which is that as a result, we should probably spend more to invest in climate change abatement. And I'm not sure that would be the takeaway for me necessarily from this, right? If yes, the social cost of carbon goes up, and that's exactly right. But the central thing is, to the extent that it comes from this decline in the risk-free rate, the same is true for essentially all other investments too, right? So if the discount rate goes down, it increases the value of investing in climate change abatement, but it essentially increases the value of investing in everything else at the same time. Just have a look at the increase in the stock market, right? A lot of, I think, why the stock market has gone up so much since the 1990s is just this continuous decline in the discount rate. And so it's unclear whether or not this decline in the discount rate actually leads to an increase in the relative attractiveness of investing scarce resources into climate abatement versus, other sort of productive activities here. Now, it could be that, declines in the discount rates have actually a larger effect on climate abatement investments than on other investments, because you might expect the duration of these investments to be longer, right? More of the benefits come in the very distant future, or the medium term to long run. And so if the duration is higher, then we know from simple bond pricing that a decline in the discount rate leads to a disproportionate increase in the valuation. But I think in terms of thinking about how much we should invest, it's always this relative comparison. And so the question is, would we otherwise, if we would otherwise have spent it into lower duration investments, then I think the relative attractiveness of the climate abatement has gone up. But if, say, you would have invested otherwise into infrastructure projects, which often also have a 50, 60, 70-year-old long payoff horizon, it's unclear whether a decline in the risk-free rate dramatically changes the relative valuation. So I think in order to answer that, you need to take a stand of the horizons over which climate change abatement pays off. And there's a lot that would go into that. Now, what we've learned here is going to then be an invaluable aspect of, that would feed into that valuation. But just, as kind of Michael was saying, like, what are sort of the next steps in terms of getting, in terms of figuring out how much more we should spend? I really think that's another point of really, it's really important about modeling the payoff structure and the cash flow structure, because if the duration is the same as the stock market, the relative attractiveness hasn't changed, even though the social cost of carbon might have doubled or tripled over the last few years. So really great paper, and I'm glad that you guys are working on this, doing more on this. I'm glad to see the San Francisco Fed putting in a stake in the ground, and also it's great to see Ralph and other Feds thinking about this serious, and like you guys in the Ukraine putting it on the program. It's really something that people should pay more attention to, and it's really fun to see that happening. Thank you.
Great, many thanks, Johannes. We have a first question from Francois.
Yeah, so I had a question actually about, I think a bit similar to the point that Johannes made, which is that if you want to think about the implication of a lower R-star for the optimal investment in climate change, I think you have to think a little bit about why R-star is declining. Because to give an example, if R-star is declining because expected growth is falling, then presumably the benefits to climate change abatement are also falling, because you're going to have less output in the future, so you're going to have less damages in the future, and so there's also, so it's kind of the two sides of the cost-benefit equations are affected by a factor, right? And then you can't really deduce just from the price what you should do. And you could also make the same point with uncertainty, I think. But anyway.
Yeah, great point. I mean, this is absolutely important to address in future research, to really incorporate both sides of the equation into this analysis, where in the climate economy model, you have lower R-star there as well, right? So we're kind of, this is more of an illustrative calculation of the kind of magnitudes of what this could imply for given damages. But yeah, that is on the research agenda to bring these two together, the damage module, these different modules. Lars Hansen yesterday was saying in our virtual seminar on climate economics that you can't really treat these different modules separately. A lot of people do this because it's kind of the only way this is manageable right now, and we're kind of doing this separate discounting module analysis, but yeah, absolutely important to integrate it with the other modules. Thank you. Great discussion, Johannes, really appreciate it. Nice to see everyone, and yeah, thanks.
Great, many thanks to all. We now have a 5-minute break until the keynote. Once again, thank you all. Hope to see you all in about 5 minutes.
Sasha, Farina, let's make sure that Mike Golosov is unmuted.
Yep.
Hey, Mike, good
Can
to
you
see
hear me?
Yes.
You see.
Excellent. So I guess we'll take another half a minute. Mike, do you want to share your slides?
Yeah, that would be this way. Let's see if everything works. Can you hear it?
I can see it, yes. Do you want, yeah, maximize, good. Do you want to try to browse?
Does it look good?
Yeah, it looks great. Ready to start?
Yes.
Mike, you okay with 45 and 15?
Yeah.
Okay, sounds good. Okay, well, it's 10:11. Let's start. And it is a great pleasure and a privilege for me to introduce our keynote speaker today. Professor Mikhail Golosov is a Homer J. Livingston Professor of Economics at the University of Chicago, where he has been since 2017. And previously, Professor Golosov has also held positions at Princeton, Yale, and MIT. Mikhail produced a number of highly influential papers in the areas of macroeconomics, public finance, and political economy. And overall, Professor Golosov has made tremendous impact on academic research and policy. In particular, Professor Golosov has spurned a new literature that studies applications of dynamic mechanism design problems to public finance that today is known as new dynamic public finance. And currently, Professor Golosov is a co-editor of the American Economic Review. Mike, it's a great pleasure to have you give this keynote speaker lecture at this conference. Welcome, and we look forward to your talk. And please take it away.
Thank you very much, Alexei. So I want to talk about monetary policy and in New Keynesian models. So the New Keynesian models are a workhorse of a workhorse framework to guide monetary policy. One way to think about the three equation version of this model, which is familiar to central bankers all around the world, is that it's emerged as an attempt as a micro foundation for the ideas developed over almost a century ago by economists like Keynes and Phillips. Since it abstracts from any meaningful heterogeneity, I'll refer that representative agent New Keynesian models, or rank. There are good reasons to think that that basic rank model is becoming outdated for two reasons. Now we have, in the recent 5-10 years, we got access to much better data to understand both how aggregate shocks go through the economy and also the effect of monetary policy, various margins it affects. And also we have much better, and our understanding that heterogeneity grows very rapidly, every month. And also we have much better computational techniques these days and study economies where there's a lot of agents which match closer to this high quality microdata is about as easy these days as it was to study representative agent DSGE models 20 years ago. So in the last 5 years or so, there's been a lot of work to build a new generation of New Keynesian models, which would be consistent with both macro and micro facts, which come from the from this new data. And so what I want to do is to talk a little bit about the type of insights which are coming from this heterogeneous agent New Keynesian model, so like Hank. In my talk, I will focus mostly on the normative implications. That is, how monetary policy should be conducted in realistic heterogeneous agents environments. So my talk will consist of 3 parts. First, I will give a review of a textbook, a rank model, and remind the main normative insights that emerged there and the reasons for that. Then I will turn to heterogeneous environments and explain the new insights which will come there, and also which features on the data drive those insights. This part I will base on my joint work with Anmol Bandari, David Evans, and Tom Sargent, and I'll spend probably the most of my talk there. And then towards the end, I will kind of step back a little bit first and try to give a little bit of a sense about other very interesting work going in this area, both kind of on the data part and on the modeling part. And then we'll kind of give some thoughts about like going forward, and also like which role central banks can play in developing this literature. Right. So let's start with reviewing monetary policy in ring. So let's think about the most basic textbook New Keynesian model. So it has two features. It has two main actors. One are firms. They are monopolistic and competitive and have sticky nominal prices. Sticky nominal prices is the reason why monetary policy, which controls nominal variables, is effective in affecting real variables in the economy, like output. Monopolistic competition allows firms to have some pricing power over its goods. And then there is a representative. There can be a lot of consumers, but standard assumption they're all the same. So representative consumer supplies labor to firms and buy goods produced by firms. Other assumptions which are implicit in that framework are about fiscal and monetary policy. Fiscal policy in New Keynesian models is sluggish. It cannot react to the business cycle shocks, the shocks which kind of typically cite in this. Monetary policy is nimble. It can react, and that's the only policy tool. This assumption, in part, it's probably realistic. Congress and parliaments tend to act much slower in changing laws than central banks in changing nominal interest rates. But it's also it's not an innocuous assumption in this literature. Fiscal policy in New Keynesian models can do everything that monetary policy can do, and usually better. So monetary policy is kind of the second best tools here. The New Keynesian models, like once you write it down, it has a lot of equations, a lot of optimality conditions. But then once you kind of simplify them, everything collapses to three equations. So this is my version of the three equation rank model. There is single household there, so welfare is just the utility of the representative consumer. Once you simplify it and approximate that utility of that consumer, welfare ends up being some constant, which does not depend on the monetary policy, and the loss function. The losses from that constant comes from two things. It comes from pi inflation and x output gap, and alpha is just some coefficient. Output gap is the difference between the output and the sticky price economy and the hypothetical flexible price economy. So this loss function is minimized if there is no inflation and the output gap is closed. You follow the flexible. The relationship between inflation and output gap ultimately is linked to the firm's optimality condition, which is also known as Phillips curve. So here's the second equation, shows that this basic version of the Phillips curve that shows some short-term trade-off between the output gap x and inflation pi. Finally, the last equation tells us how monetary policy, how nominal interest rates influence the economy. So that comes from the early equation of the representative consumer, and this is it's also known as IS equation, which ties output gap today, expected output gap tomorrow, expected inflation tomorrow, nominal interest rates that are controlled by the central bank, and the efficient real rate, that is again the real rate which prevail in the flexible price. And so these are the three equations which summarize the workings of the ring economy. The central bank controls I through this equation that influences pi and x, which together with the Phillips curve affects the welfare of the consumer. All right, so that has some, at first sight, nice features. So central bank, the normative implications come down to maximizing welfare or minimizing this loss function between square of inflation and square of output gap. As Alan Blinder mentioned today, this quadratic function, it minimizes when you set inflation and output gap to zero. If you look at that, this objective to minimize inflation and output gap kind of consistent with a dual mandate that many central banks have to pursue low inflation and low output gap, saying that the Federal Reserve, the exact wording from the Congress is that Fed is supposed to promote effectively the goals of maximum employment, which is interpreted as closing that output gap, and stable prices, that is zero inflation. All right. Now, so there is dual mandate. So the Fed is supposed to follow like two objectives. Another feature of the Keynesian models is there is no trade-off between these two objectives. Low inflation implies automatically a low output gap, at least in the long run. What I mean by that, if you look at the Phillips curve, this is the Phillips curve from the previous slide. Now, suppose central bank sets the nominal interest rate to have no inflation. So then all pi's become zero. And then from this equation, you see that the output gap is zero. So that's, you minimize inflation, you minimize output gap, you maximize consumer wealth. So these are the long run results. In the short run, shocks may disrupt this relationship. So let's think about a couple of shocks. So let's start with the productivity shock. Suppose there is a productivity shock, a negative productivity shock. So now there is what's known as divine coincidence. How should central bank respond to a productivity shock? Turns out it shouldn't really respond to it at all. As long as it's keeping its inflation low, the output gap will close itself exactly for the same reasons I showed you before in the from the long run logic. Let's think about it. Another shock, a shock to the Phillips curve. All of a sudden, there's an additional shock to the equation I give to the Phillips curve. All of a sudden, there's a push on the inflation, even holding the output gap, even the output gap doesn't change. So that's kind of, think about the real world, all of a sudden inflation goes up for like no apparent reason. So that's kind of a classical response. That calls for the classical response of monetary authority when inflation goes up. So you increase the interest rates to contract the output a little bit, reduce output gap, and decrease the inflationary pressure. So this is known as leaning against the wind, say in Galler's textbook in describing monetary policy. Inflation goes up, the central bank increases interest rates. Inflation goes down, it cuts it down. In the Keynesian model, so here I like to think about shocks because that's what ultimately like affect the economy. Essentially, in the Keynesian models, at the end of the day, there are two equations. So all the shocks can be summarized as like either equation to IS or either shock to IS or shock to Phillips curve. You can invert that two system of equations, find the optimal interest rate. That will look as a Taylor rule. Doesn't make you think about shocks at all. So the optimal policy you can show can be just, or approximately optimal policy can be some constant times some coefficient on inflation, some coefficient in output gap. The coefficients themselves are pinned down by the model. If you know things like elasticity of labor supply or risk aversion of households, that will tell you, that will pin down what these coefficients are. And then that tells you that the optimal rule can be like very mechanical. You just, all the central banks need to do is to measure inflation, measure output gap, and just set the inflation, set the interest rate using this. Those are kind of the main insights that come from the normative point of view from these models. And I'll kind of, now I will go towards re-examining them in the heterogeneous agent. All right, so what do I mean by heterogeneous agent? So what I'll do now, I will take this basic New Keynesian model, and I will take a basic model that macro labor literature uses to study earnings and savings of households. And I'll put these two together. There will be a lot of heterogeneity. There is a lot of heterogeneity in the data. There will be a lot of heterogeneity in this hybrid model. People will be heterogeneous in earnings. They will be heterogeneous in wealth. They will be heterogeneous in exposure to aggregate shocks. There will be undurable idiosyncratic shocks. Basically, a lot of things which are happening in the data. The nice thing about this new generations of kind of macro labor models, that they fit very well with the high quality micro level data that became available, to the profession in the last, say, 5-10 years. What I mean by this high quality micro level data, we have like administrative panel data on earnings. Often we have access to tax data where we know exactly the source of earnings. There's very high quality financial data where we know assets of individuals. we know their assets, we know their earnings, we know their taxes, we know how they save those money. We can construct budget constraints on a very micro level. So we kind of understand these data sets have ability for us to understand how various shocks kind of permeate through the economy on the level of individual households. and the heterogeneous age environments map very nicely into it. And so what we'll do, we kind of merge these two models together, and then we'll study optimal monetary policy, like revisit the same lessons I showed you before, but in this heterogeneous economy. Now, you write this economy, there will be a lot of equations there. There will be the paper itself, chunk of that spends about describing numerical techniques that can be used to solve them. I don't want to go into, I'll talk about the economic insights at the moment. And the particular, once you think about the economic insight, once you think about some basic features of the data, of the micro level data, I'll argue that those insights are kind of straightforward and not surprising, neither qualitatively nor quantitatively. So one channel that emerges from studying monetary policy is like, there is one additional, like in the standard rank model, basically it's a trade-off between pursuing price stability and closing the output gap. And as in some like long run sense, there is no real trade-off between the two for the central bank. Now there is at least one extra channel. I'll call it provision of insurance against aggregate shocks. Quantitatively, not only there is like this new channel, but quantitatively it's an important channel. Welfare gains from insurance swamp potential losses from price instability. It's not very surprising that losses from losing a bit of price instability are low. Think about the basic public finance and Harbinger's triangle. If you start with economy with zero taxes, a small tax to the first order has no effect on wealth. If you live in the environment with very low inflation, close to zero, small deviations, temporal deviations from that also will have no first order effect on wealth. So now let's understand why welfare gains from insurance are large. Okay. So, and here again, insurance against aggregate shocks. So first of all, aggregate shocks in the data are very small. Standard deviation of log output in the US is about 3%. 3% is not a very big number. If every once in a while you get a 3% pay cut in your income, temporarily 3% cut to your income, it's unpleasant, but it's not in the end. It's not the end of the loop. How bad it is for welfare, that really depends a lot how exactly that output losses are distributed in the economy. A world where 100% of households lose 3% of their income is very different from a world where 3% of their households lose 100% of their income and gets on the brink of starvation every 5 years. So these are two extreme cases. You know, reality is somewhere in between, but on some level, I want to argue that we are much closer to the second world rather than the first in the data. So why is that? So in the data, aggregate shocks have very heterogeneous impact. For one, as you can imagine, it's not like everybody loses 3%. A lot of people have no changes in the income at all. Some people lose their jobs. Moreover, the type of people for whom losses are most concentrated, it's not the probability of losing jobs or losing getting a pay cut is uniformly distributed with an earnings distribution. I'll show you in a second that those losses are quite concentrated. Moreover, even if losses were concentrated, how much you are able to cope with shocks would vary depending on your assets. People who have a lot of assets, a lot of savings have much easier to cope with the same shocks than people who have a big mortgage that they need to pay. So here's an example of the type of new insights that come with high quality data. So this is the graph I took from the paper by Fatih Guven and several of his co-authors. So here they use US tax data, and they rank households by earnings, what earnings were a year before a recession hit. And they look at the four recessions, four recent recessions for them were at the time of their rank. On the y-axis is how much, so this is earnings by percentile of households before the recession. And the y-axis is how much income in percentage term those households as a group, as in each percentile, lose when the recession hits. If burden of recession was shared equally, that is, a 3% drop in GDP would lower everybody's income by 3%, then these lines would all shift down and would be flat. As you can see clearly from this graph, they're not. They're very far from being flat. Most of the burden, the households on the left of the earnings distribution lose much more earnings in percentage terms than households on the right, the tail of the distribution. So now let's think about what that implies from the normative perspective in the heterogeneous agent model. Suppose a recession. Suppose we have a negative productivity shock that drives a recession. Again, if everybody's consumption would fall equally, I mean, negative productivity shock would imply that output would go down. So if everybody's consumption fell equally, that would be efficient thing, and we'll be back to the divine principle. In the data, the impact of the shock would be heterogeneous. As you saw in the previous graph, earnings poor households with low earnings, tend to be hit more than the middle class. Moreover, households which are asset poor or borrowers also would suffer more than asset rich and lenders, just because the latter have this more assets that they're able to smooth their consumption better than the former. But now let's put the two things together. Let's think in the data, who are the households who are suffering the most? They are earnings poor households, which also in the data would be the households who have the least asset, the least savings. So those guys got double whammy. So with the high recession, which most of the burden falls on the households who are the least able to cope with it through savings. So that's the reason why the insurance mechanism, why the welfare from providing insurance, the welfare gains from providing insurance would be high in this type of setting. And so in Keynesian model, central bank can use monetary policy as a tool to provide insurance to affect negative impact of the shocks. So in this graph, I plot two policy responses together with a couple of variables to a temporal negative productivity shock. One is a textbook rank economy, which you would get from thinking about the shock in Woodford and Gallup book. The second is exactly the same economy, except people are heterogeneous, and that heterogeneity again is disciplined by the data. So the red line are the responses in rank economy. So there is negative productivity shock, output falls, and then it's mean reverted, so the output slowly grows. As there is a divine coincidence, central bank just wants to keep the inflation zero. So that's what you see, the red line is flat. And then mean reverting negative productivity shock implies that efficient rate of interest rates shoot up and then slowly goes down. Central bank uses nominal interest rate to just follow exactly the same path as the reason. So that just graphically shows exactly the same. That graphically shows the insights which I described before about optimal response for in the ranking. Now contrast it with the blue line in the heterogeneous agent economy. Rather than increasing the nominal interest rate, the central bank cuts it and cuts it quite aggressively. The reason why it cuts it is because it wants to generate inflation, it wants to achieve two things. One, it wants to cushion the output loss. Negative productivity shock does lower the output, but central bank wants to output to decrease a bit less than what this idealized efficient level of output. The reason it wants to decrease it a bit less, it wants to cushion a bit of a fall from the output for the low earnings, who gets to bear most of the burden. The second, it also tries to lower the interest rate so that it evens out the burden of the shock between savers and borrowers. The exact details how these lines go over time will depend on the details of the economy or the additional frictions. But the general message that one channel the central bank will try to use to provide insurance will be the same independently of the details how you measure the exact timing of different shocks. Now, so that's negative productivity shock. The central bank would like to do an expansionary policy. Now, I focus on the negative shock, thinking about the recession. If I did the opposite and think about unexpected boom in output with the productivity shock, the optimal response would be the mirror image of what I described. So that brings me to another important point. What I'm really talking here is about insurance rather than a redistribution. So the policies I'm describing, on the net expected income flow for all households are roughly zero from my deviation from going from rank to hang. What the central bank does is try to provide a state contingent payments to kind of offset the unequal burden of various aggregations. If you're interested in the redistribution, if you're interested in more permanent reshuffling of resources across households, fiscal policy, in principle, you can do it with monetary policy, but fiscal policy will be much better and much more suitable tool. It's also something which you don't need to be very nimble. You can kind of set those things once and for all and change it at a much lower frequencies. Now let's go to let's think about the second shock, the markup shock. Again, so let's just remind a shock, the kind of shock we'll be thinking about. All of a sudden, there is a shock which kind of pushes up desired prices of the firms relative to their margin. So that increases inflationary pressure. So standard recommendation, inflationary pressure all of a sudden goes up. So the central bank should lean against the wind. So the central bank should offset that by raising nominal interest rates to lower the aggregate demand. Lower aggregate demand also reduces firms' marginal costs. Okay, so let's think about that a little bit from the point of view of the data. What are like marginal costs in the micro level data? Well, firms' marginal costs in micro level data, those are wage payments. So marginal costs, they have names, they have social security numbers. They're very specific for people in the data. So what markup shock does, it increases return on equity or returns on holding the firms. It decreases returns on holding the. Now, if it's exactly the same people who own the firm and work for the firm, as is the case in the representative agent economy, it doesn't really matter that this shock happens. All that happens is that your total income remains roughly unchanged. All that changes is the labels on the income. What was called before your labor earnings now are called your dividends. But now once you start thinking about heterogeneity and kind of map those things in the data, you'll see that those are in the data, those are not going to be the same. Equity holdings in the data are highly skewed. Most households have no equity holdings at all. Households in the right tail will have most of their. So you have a markup shock, which effectively has a very unequal impact across households. So the gains from the insurance will be large. Moreover, the policy of rising interest rates in order to reduce firms' marginal costs, that will make things worse. However, the workers who with no equity, they're already suffering from the shock, lowering their firm's marginal cost further will lower their wage. So here's the same graph, but I show optimal response to a markup shock. So I'm thinking about positive markup shock, which also will be contractionary in the new Keynesian model. So the red line, let's start with the red line with the rank economy. There's a positive markup shock. The central bank responds by increasing nominal interest rate, leans against the wind. Inflation goes up. It goes up by a little bit. The central bank offsets some of the inflationary spike, but not 100%. Output falls. That's kind of the point of rising nominal interest rates. And I also show that real wages of the economy fall as well. Contrast it with the response in the Hank economy. In the Hank economy, the optimal response to this policy would be to cut the interest rate and you cut it much more aggressively than rise of the interest rate in the ranking. That generates a spike in inflation, a much bigger spike in inflation than what the market shock itself would be. And the reason the central bank would be trying to do that is to kind of offset some of the wage drop that is driven by the to offset the negative effect on wages, at least partially from the high market. So the central bank constantly in these models constantly trading off a bit of you lose a bit of a price stability, but you try to offset whatever the distributional impact of the shock is. So in response to the markup shock, you do the exact opposite from what standard leaning against the wind recommendation would be. Okay, so what are the broader? So now let me step back and kind of talk about the broader lessons which we get from this, and also like some of the implications. Well, one what I kind of try to describe is like provision of insurance against aggregate shocks should be an important concern for monetary policy. That's a tool which can provide insurance. It's also unlike a representative agent environment. Even if fiscal policy can act as fast as monetary policy, you typically cannot do everything with it alone, or at least with a simple monetary policy, simple fiscal policies like temporary stimulus or unemployment insurance. You can help, but you cannot go all the way. The second lesson, which kind of comes as almost corollary of everything I showed you before, simple Taylor rules, where inflation is the optimal interest rate, that interest rate is just some mechanical formula which links inflation and output gap, typically will be a poor approximation of what optimally central bank could be doing. Not very surprising from what we see, given that Taylor rule captures well the rank responses, they will not be capturing that well Hank responses. But there is also a broader message. You have aggregate shocks. In general, they will not be summarized by their effect cannot be fully summarized by the effect on the two equations. You kind of want to think about how exactly the incidence of those shocks falls within the economy will vary by the size of the shock. And similarly, when the central bank responds, just like the aggregate shocks themselves, central bank response also typically will not be shared equally. So you kind of want to. So the broader lesson is that the central bank should consider both what happens to the shock, how the incidence of that shock distributed falls along different players in the economy, and if it sets its policy, when it changes its policy, whether it offsets some of those effects, make it worse, does something affects households, which are in some orthogonal way to the way the policy. Ideally, kind of trying to set the policy to offset the heterogeneous impact of aggregate shocks is kind of the broad recommendation. All right. When I present this work in central banks, I often get two types of concerns about the lessons which come out of it. One concern is, sure, it all sounds good, but provision of insurance is not in the dual mandate. Definitely, it's not in the dual mandate of the Fed. In some narrow sense, yes, that's definitely true. It's not. But also, the dual mandate, at the end of the day, reflects last century understanding of monetary economics, when we thought that all the interesting effect of aggregate shocks or important effects of aggregate shocks on monetary policy can be summarized in the two graphs, which later we wrote as two equations. Now, I think the recent research emphasizes that effects of both aggregate shocks and monetary policies are much richer, and this framework kind of calls you to take that into account. The second concern is how thinking about redistributive impact of the shocks and take them in setting monetary policy will affect political independence of the central bank. Central banking are independent, the thing can go, but once you kind of start explicitly acknowledge that there will be winners and losers from monetary policy, there will be more pressure to kind of for Congress to step in and wait on those issues. I will leave the political economy discussions of central bank for another day. But what I want to say that there are winners, no matter how you think about it, there are winners or losers of central bank policies. And even winners, the winners of the central bank policies will not be all the same. Some winners will win more, some winners will lose less, somebody will lose. So this framework, all what this framework does is explicit acknowledges that and thinking systematically how to use that in order to improve welfare. All right. So going forward, so now let me step back and for a bit. Before going forward, let me step back and give a bit of literature over. I think we're in the monetary economics, we are in a very exciting, we live in a very exciting kind of time from like pure like academic, from like academic research point of view. I think there are like three major advances which have been happening in the last 5-10 years that has a potential to majorly change the way we think about monetary policy. So what are those advances? Two of them are empirical. One is now we have this very high quality data, often administrative data, to study how aggregate shocks affect the economy, to study what frictions economic agents face when they adjust to those shocks, and how monetary policy itself, which is also, you can think about it as a form of aggregate shocks, similarly permeates through the economy. So from the examples of the impact of aggregate shocks that I'm thinking is the paper by Fatih Guvin and co-authors. That's just like not a representative, not an exhaustive list of references. This is the purely to give you some sense of the literature, and also I put the date so you see that this is really happening right now. In terms of the frictions, there is also like a lot of understanding like what frictions agents face. The world where everybody has their portfolio of aero securities, which provides all insurance against aggregate shocks, is very different from the world where people live hands to mouth and cannot insure themselves even with the most basic savings account. So the work, for example, on MPC heterogeneity by Deppellini and Pistaferi kind of points out to the type of frictions that agents face. The impact of monetary policy, as I mentioned, like monetary policies themselves have a very heterogeneous impact. Here, Yuri and Olivia have a truly groundbreaking work thinking about this. I mean, in fairness, Yuri has probably like, and Olivia has pretty much groundbreaking work on pretty much every bullet point here. Just in fairness to others, I only put their names in this bullet point. Here I focused everything on in households, in part to kind of have my talk more focused, in part because in the end, welfare is utility of households. But there's also been a lot of parallel work thinking about firm side, thinking about heterogeneity on the firm side, the work say by Etanel and Winbury, or thinking about adding other sectors, like thinking about explicitly banking sectors and how banks, which ultimately are the key chain in the key link between actions of the central bank and the economy, how they affect them. So there's been a lot of like fascinating work there. So this is in terms of the pure like administrative data and allowing us to think. The second important work is how shocks work, how monetary shocks work, how responses of monetary shock policies affect the economy. So the literature have been doing that for for decades, for many decades now. One additional advance, which is quite recent, is now we also have this very high frequency data. And having high frequency data allows us both to better identify monetary shocks, and also we can now see how those monetary shocks permeates through the economy almost in real time. Like some examples of that would be the work of Bernanke and Kuttner. That's the only work which is like on this list, which is was done more than 10 years ago, Nakamura and Steinson. Again, Yuri has a lot of papers. And that's interesting work, both because it points out how those shocks work, better identifying those shocks, but also it shows that much of the actions of monetary shocks are very different in the data, is very different from how monetary shocks work in the New Keynesian model, which kind of guide conduct of the shocks. And that's incorporating those mechanisms into New Keynesian models fully. And then finally, the third big advance is the invention of new computational techniques to solve and estimate sophisticated heterogeneous agent economy that closely match to the data. Until recently, solving taken a model which is naturally mapped into the micro level data, and solving it was hard. Researchers had to make shortcuts, look at the economy with 2, 3 agents, we have tried to use that. The problem with that approach is that it's once you start taking shortcuts, it's very hard to know how going from like the full administrative data to economy with 3 agents, what are the shortcuts, which shortcuts are innocuous, which shortcuts are really important. There's been an explosion of work in the recent years, kind of developing computational techniques which don't require you taking those shortcuts. On some level, we are either there or like almost there to the point where solving a heterogeneous agent economy or estimating heterogeneous agent economy is hardly more difficult with any shortcuts at all than would be solving the representative agent DSGE model 20 years. And so I think these 3 lines of work suggest that workings of both aggregate shocks and monetary policy are quite different in the data from the way they describe in the textbook McKinsey. And now what's possible is to kind of have frameworks which consistently puts like all the power of like micro and macro, to have frameworks which map very well into like macro and micro level data, which allows us to kind of connect those models almost to like specific individuals we can see in the data, understand why those individuals suffer from the shocks, who suffers, who doesn't suffer, what type of policies we can do to kind of even out this. And I think central banks and research departments and the central banks can really take a leading role in this research agenda. Central banks, just by has a natural comparative advantage because they have access to the type of data that economists either don't have directly, it's much harder to access. They have all the infrastructure to kind of study, to utilize, to write down these models, to put those things together. And I think that can lead to very interesting insights that can be used in the future to guide monetary policy. So that's all I want to say for today. So I'll be very happy to take questions.
Thank you very much, Mike, for this very insightful presentation. While we're getting questions, let me ask you a first question. Looking at your responses in the model and looking in particular at what the central bank does with inflation response, I want to offer a sort of a different interpretation of how to compare them. Inflation response in the Hank just goes up very sharply after a negative shock and then goes down, overshooting on the low side. All right, and then goes back to kind of steady state, right? So there's no overshoot in the rank. So to me, what this inflation response on the Hank looks like, it's in response to a bad shock. Central bank is trying to generate a one-time sharp rise in the price level and keep it this way. So, and the reason why the central bank wants to do this is because it wants to generate redistribution of wealth across, across savers and borrowers here. And I just wanted to ask you whether this interpretation makes sense. This takes me back to Dubke Schneider JPE paper when they looked at heterogeneity in wealth across households, and most of this wealth is held in, say, mortgages, right? And so a one-time inflation would redistribute real wealth across households. And I was wondering if this is the reason, if this is the type of mechanism that is very strongly makes central bank to do what it seems to be doing, which is generating this one-time spikes in inflation after contractionary shock.
It's one of the things. I think this is like the closest would be in response to the graphs I showed you in response to a productivity shock. And the reason here is in part is what you described. In part, it's really you have a productivity shock which lowers the output, and the burden of output just falls differently between different parts of the distribution, and just kind of you don't want it to fall as much because that's like a very unequal shock. In part, you try to even it out by not letting the output drop very much. As partially what's happening is you try to even out gains and losses between borrowers and the savers, and the data, big chunk of the borrowers, like most borrowers are the people sitting with on their big mortgages. That's what happened. The reversal, the drop and the increase, this is the part which I mentioned briefly. What I did here, just to kind of have the parallel, I kind of had the most bare bone. My comparison was the most bare bone New Keynesian model augmented with heterogeneous agents. If you think about the Phillips curve, you have the output gap, you have inflation, and you have expected inflation. So you kind of, there are incentives for you to try to move them in the opposite direction, just kind of from the logic of that model. So you see this reverses in policies. The exact path, and that's what I was, the exact path, you can introduce additional mechanism. You can introduce investment adjustment costs. You can introduce how exactly like some more restrictions on the portfolios. Those results will impact how about the exact paths of the policies. And this is why I don't think this is like the last word on like what policies should be. I think we want to have, this is like more like a first step in the kind of thinking about what are realistic restrictions and things like that. But all the experiments which we run, we try like a bunch of different restrictions what people have. You have the same lesson, like within the constraints of what policy can do, it tries to provide insurance. The exact forms of like how exactly the timing of how long, like whether the nominal rate is short-lived and reverses, or whether it's long-lived and kind of takes a while. Those details depend on the additional frictions that we put.
Okay, thanks, Mike. So we'll take questions. Next one is Matthias Meyer, and after that, Francois Gouillot.
Yes, thanks. Great talk. I enjoyed this a lot. I was wondering about the role of public insurance, things such as Social Security, unemployment insurance, etc. Whether you have included them in your model, and how they would shape the optimal monetary policy prescription in the heterogeneization model.
Yes. Thank you. That's a very good question. So fiscal policy can help. So in providing insurance. So for example, if we lived in the world where all the losses come because people all the loss from all the unequal losses come because people just lose their jobs. In principle, you can provide the same insurance in a very targeted way through unemployment insurance. In the data, not quite. So in the data, some of people lose jobs, other people don't get raises, some people keep jobs but at lower pay. There are winners and losers through depending on the savings. So if you have a very simple fiscal policies like unemployment insurance, stimulus, they help a little bit, but unlike New Keynesian models where just like a marginal tax can go all the way, that's no longer the case. They just like reduce, they help a little bit, they reduce the magnitude of the response by the adjustment, take some of the burden off of the monetary authority. In principle, if you have a very sophisticated fiscal policy which jointly looks at your savings and earnings and how much you lose and have like this very sophisticated state contingent fund, then in principle it can take all the burden away from monetary authority, just like it does in the rank economy. But that would be a much more sophisticated fiscal policy than say anything like we've seen used in practice.
Francois?
Oh, I thought I could not reply. Sorry. So yeah, thanks for the answer. So the answer is, in a nutshell, the answer is that it is in a model, but quantitatively there's simply not much, not much coming from fiscal policy to take away that role for monetary policy to provide public insurance.
Yes.
Okay.
Yes. So the type of experiments we did, we tried to say, well, suppose there is like unemployment insurance which provides you insurance against drops in income, or like suppose we can even out this graph. Suppose after tax income can be evened out completely, so that this graph is so it cuts the responses, but it cuts the response, the difference in the responses, but it cuts them by say like 30%, 50% quantitatively. It's not, given like the differences between the two are like big, it's not it's not like you go like with fiscal policy all the way to something where monetary policy looks like rank to what it looks like rank. Because it's really the interaction of earnings shocks and assets of the households.
Okay, great. So Francois, I think you can ask the question now.
Yeah, no, actually, my question was very similar to Matthias, so I'm going to start to stand away.
Okay, great. So we'll go to Guido Ascari next, and then after Yuri Gorodnichenko.
Yeah, Michael, thanks for the wonderful talk. I have two quick questions. One, you were very dismissive about Taylor rules. So on one hand, it seems to me that actually increasing the weight on the output gap can go some way towards the optimal policy, given the input response I see. And second, the question is, did you think about how and if there is a simple rule that could map into an optimal policy, and how does this simple rule would look like, and how it would look like, would be different from a Taylor rule? The second point is, now, if monetary policy provide insurance, this is going to distort, obviously, the incentives of people in savings, for example. And that might have some longer effects that maybe we should worry about or not.
Yes. Thank you. Taylor is a good question. I put it like a little bit provocatively. I think a good question is, which we haven't, I think it would be, it's a very interesting question, is to think like whether there are like some simple rules, like relatively simple rules, which can approximate, the policy response. And it's a good open question. We don't know the answer to that. Simple tweaking with the parameters on Taylor rule will not work. As I said, sometimes things go in their own direction. Sometimes the persistence, the Taylor rules themselves, they kind of impose strong relationship between persistence of the shocks and persistence of interest rates. And also, if you think about the shocks, the shocks themselves the aggregate shocks themselves may not necessarily even affect the aggregates like output very much, but they can have very redistributive impact within within population, and Taylor rules will not be like capturing those very well. Like in general, like shocks are not, there will be no easy mapping between shocks and how what they imply about insurance to just two variables like inflation and output. But I think you're on something when you're thinking that in principle maybe like in the data there's like some heterogeneity between borrowers and savers, how shocks go and the income distribution. Maybe we can just like summarize that those effects in a couple of variables, like say a dispersion in earnings or something, and put that into the Taylor rule. So I think that's like a very interesting question, and we just haven't thought about it. Didn't have time to think about it. And you had a second question. Do you mind reminding me what it was?
It was about the possible distortive behavior.
Oh, right. I mean, as with any insurance programs, there will be like some distortive behavior on the margin. But here's also like one thing which I kind of was trying to emphasize is that it's kind of a symmetric response. So it's not like a capital tax when you increase capital tax, and it's the same capital tax in all states of the world. This is like a state contingent response when in bad states of the world it goes one direction, in good states of the world it goes in the other direction. If you really think what central bank is trying to do in these models is if households portfolio consisted of euro securities, which provided them with a state contingent return, which fully hedges like how their incidence of aggregate shocks, then there will be no problem at all. In the data, except like in the data, we don't see people holding those portfolios. So effectively, what central bank is kind of trying to do is to do something to like goes towards generating the payoff for the households, which in the direction of which they would have gotten it with the euro securities.
Thank you.
Yuri?
Mikhail, thank you very much for your very interesting talk. I think it's
Yuri. I'll put this slide up there.
Yeah, and thank you very much for mentioning me. I must say it's not just me; it's a great team of co-authors that I always have. But that's not my comment. My question / comment is this: I totally agree with you that the future of macroeconomics is in incorporating heterogeneity of economic agents in our models. And this Rand versus Hank, it's a great example of the big debates we have in macro and the future of macro. One question for you is this: Rand and Hank, they have different implications for the transmission of monetary policy. With some oversimplification, Rand is about intertemporal substitution, Hank is about income effects. And when I'm looking at the responses of macroeconomic aggregates to, say, monetary policy shocks in the US, you have an interest rate cut, and then you generate a boom in purchases of houses, in purchases of new cars. And so that would be consistent with basically intertemporal substitution. You lower the cost of a good, the price of a good, people shift the purchases of durable goods from the future to the present, and so I know in the Rand model there is no durables, and it's probably not a good model to describe this type of goods. But this kind of response I thought would be inconsistent with Hank models, where you should see a lot of responses of non-durable consumption services. In particular in the US. And we know services, non-durable consumption in general, is not very sensitive to monetary policy shocks. So I was wondering how you can square, these predictions and the empirical facts. Thank you.
I'll slightly change the, I guess. So my version. Like, so my reading of the literature that neither Henk nor rank would be like a particularly good description. Not the Henk which you mentioned would be a particularly good description of how shocks transmits in the data. Like, you know, the Henk and income facts, I think like you were thinking about the Kaplan-Moll-Galante, which invented the Henk. And, you know, the way they set it up that model in the first place. You know, you change interest rates. If you think about it, something goes to the government budget constraint. There is an inflow of money to government budget constraints. You know, kind of almost as a residual, that thing goes to the household through transfers, and that's kind of generates the income effect that what you're thinking about. And I think that's one way to think about it. That's kind of a first step of thinking about those Henk models. I'm not entirely convinced that if I actually think about data on transfers and kind of start building those transfer flows, that's how monetary shocks actually transmit in the data. And but the part which I do agree with them, you know, and you know, the intertemporal transmission, it's hard to, given that, you know, what we know about the data, given like how many households have no meaningful savings at all, it's hard to imagine that 100 or something like close 100 to 100% of households are on their early equation, so that would be a good description. And again, like, if I think about work of like people like Bernanke and Kuttner, so they kind of argue that it's completely different mechanisms, like not present in like risk channels that would account for bulk of the transmission of monetary shocks. So the way I'm going back to durables, the way I'm thinking about it, these are all very recent papers. These are all first steps to kind of, this is like almost like a proof of concept. We can have models, we can have them like map into the micro level data. We have like different ingredients, but there's like a lot of work to just like put those things together. Adding durables, thinking, you know, how those things work. Like, I think like, you know, one super exciting thing would be to combine that with, say, your work on how monetary shocks transmits within the distribution, like different households of different earnings, who is affected, firms versus like firm owners versus like business owners versus whether households increase durables because now it's become cheaper to buy them, whether their prices decrease, where you know, something else happening. Like, you know, we have like all the things we have like all the ingredients. Like, the way I see about it, we have all the ingredients to kind of understand that on like very like micro level. It's kind of just a matter of like putting those things together.
Well, I think this is the high note, and it's good to end on this high note. I think I'll speak on behalf of everyone who is here today, and on behalf of the organizing committee, to thank you, Mike, for coming in and giving this excellent lecture and for answering our questions. Thank you. And for everyone, the next session starts in about 6 minutes, and I wish you to enjoy the rest of the conference.
Thank you very much. Thank you, Alexei.
Thanks, Mike. Good stuff.
Okay, welcome to the last session of this conference. So the session is focused on fiscal policy. And as you could see from the questionnaire, the first question was whether the pre-announcement of future government spending improves the effectiveness of the welfare policy, of fiscal policy. And majority of people agreed with that. A large fraction also were certain. So I will give floor to Guido Ascari from University of Oxford, who will shed a light on whether it's a good idea to pronounce or not to pronounce future fiscal policy. So the floor is yours.
Thank you very much, Christoph. Let me share the screen. Okay, can you see my slides?
Not yet.
Right. Now you should be able to see my slides.
Okay, now we can see.
Okay. Right, so shall I start? Yeah. Okay, so first of all, thank you very much to the organizer to put our paper into the program. A terrific conference. I'm enjoying these 2 days very much. So thanks a lot. This paper is a joint paper with Peter, Anna, and Alessandro, and it's about fiscal foresights and the effects of government spending, and especially is about the effects of the anticipated increase or decrease in government spending. So anticipated changes in government spending. Now, this is actually most, as also Michael said, this is also, most of the times, if not all the time, fiscal policy is pre-announced. And we can talk about inside lags or outside lags. So inside lags is about the fact that there are any policy bill, fiscal policy bill is discussed in Parliament, and therefore it takes some time before being approved, and then it takes some time, and that's the outside lag in being actually implemented. So fiscal foresight is important, we think, in government spending, and this is actually one of the main points of a seminal contribution by Valerio Remy that shows that IRF's so input response function from SVR, once you take fiscal foresights into account, give very different results from, let's say, important for the paper by Blanchard-Perotti in 2002, that was at the time, I think, the main benchmark for the VAR analysis of the effects of fiscal policy shocks. So Blanchard-Perotti, using a long sample from 39 to 2008, and using a standard identification, basically based on Cholesky, they show that government spending shock increases output, increase consumption, increase hours and real wage, and that would be a standard, what will happen in a standard kind of new Keynesian mechanism in which output goes up because there's a demand shock that increase income and therefore increase consumption, and demand for labor goes up, so hours and real wage goes up. Valerie Rainey shows that actually when you take seriously anticipation of fiscal spending into effects, then actually by using World Day dummies, actually these effects, some of these effects turn upside down. Particularly output still increased, but consumption is going down, hours are going up, but real wage is going down. And that actually points towards a neoclassical view in which anticipated increasing government spending means that the people realizes that they will have to pay more taxes in the future, and therefore their consumption contracts and labor supply goes up, such that the real wage is actually going down. What we do in these papers, so first thing we do, we redo the Rami VR. That's one example. It's the smallest VR in which we use the defense spending. I'm assuming you can see my cursor here. The defense spending by Rami, and we divide the sample in two subsamples. So one is the so-called great inflation sample up to 79. The other one is the great moderation from 84 onwards. And you can see that in the great inflation sample, actual output is going up, okay? But in the great moderation sample, output is actually going down. So anticipation of government spending seems to have detrimental effects on output in this subsample. And therefore, this doesn't square with any of these interpretations. So we try to find, if there is any possible explanation for this. And we turn to a bunch of papers here that study the interaction between monetary and fiscal policy. And basically, this bunch of papers, some of them are theoretical, or some of them are actually estimated on data. They try to point out that the period that we call great moderation seems to be identifiable with what we call in theory a monetary regime or a monetary-led regime, in which the central bank sets the interest rate and to control inflation. The government of fiscal policy adjusts the deficits in order to stabilize the real debts. And the Ricardian equivalent solves under certain conditions. There is no wealth effect on increasing debt. On the other hand, the great inflation period seems to be identifiable with a fiscal-led regime, or the so-called fiscal theory of the price level, in which the government set the deficits and the central bank simply accommodates rates to let inflation to stabilize the real debt. So the inflation or the price level is the variable that moves to satisfy the intertemporal budget constraints of the government. And in this word, there is a wealth effect of an increase in real debt. Now, therefore, what we do, we look at, analyze the effects of fiscal foresight, and in particular of the anticipated government spending under these two regimes, the monetary regime and the fiscal regime, both theoretically. So we'll study the effects of anticipated government spending in the two regimes, and both in analytical, very simple model, and for which we have some analytical results that give the intuition of how these two different regimes works for anticipated government spending. And then we look at a standard medium scale new Keynesian model for simulations. And then we look at empirical at various VARs. We do a lot of robustness, and we check this empirical evidence that I show you in the small VR. And we show that this is quite robust. And we check various identification strategy, and we also explore an issue that on which I will not have time to talk about, the issue of non-fundamentalness of shocks in case of anticipated shocks. An issue that the literature creates a small literature, yeah, so I will not have much time to talk about this. So what are the results? The results is that theoretically we show that unanticipated shocks, which are what mostly the literature looks at, are expansionary in both regimes. But when you start looking at anticipated government spending shocks, then there is a difference between the two regimes. And in particular, they are expansionary in regime F and contractionary in regime M. So output goes up in regime F during the anticipation period, while it goes down in regime M, exactly as we showed in the VAR. So then we look at various VAR, different, as I said, different robustness checks, and the empirical evidence do corroborate the theoretical results. We extend the VAR to include consumption, investment, hours worked, and real wage. We extend it to use other measures of anticipated shocks, like the Rami-Shapiro used, or the falling Gambetti, especially for the great moderation period. And we also show, somewhat to our surprise, that once you divide the sample into two, there's no difference between the Rami VAR and the Blanchard-Perotti VAR, so between the two identification strategies. So it seems actually that anticipation, in a sense, what Rami called the timing, doesn't matter once you control for the monetary fiscal policy mix. So conditional on the regime, we show that shocks are indeed fundamental, and therefore there's no evidence that shocks in the typical Cholesky identification could have been forecasted. Okay. How much time do we have until?
10 minutes.
Okay, thank you. So this is the first, the very simple Keynesian model that we look at to get some analytical results. This is based on a previous paper previous work by Peter and Tim. So it's the simplest model you can think of, the simplest new Keynesian model. In the paper, you will find a host of analytical results on the anticipated government spending multipliers on output in particular, and also in inflation. So in a model like this, you can distinguish two regimes, a monetary-led regime and a fiscal-led regime. And a monetary-led regime is a regime in which the Taylor principle is satisfied. So this parameter phi is bigger than 1, and this parameter psi is above a certain threshold, so taxes responds to the level of real debt. On the other hand, a fiscally led regime is a regime in which monetary policy is passive, so this parameter phi is lower than 1, and this parameter psi that governs the response of taxes to the debt is actually lower than a certain threshold. As I said in the paper, you will find an analytical solution for both unanticipated and unanticipated government spending multiplier. Let me just sum up what are the findings. So in a monetary regime, so let's start with the monetary regime, what happens if you have unanticipated government spending shocks? So the response of output is positive, as you might know and expect. So it's positive for two reasons. There's a shift in labor supply because there's a negative wealth effect, and there's a shift in labor demand because output is going up. What about anticipated multiplier? And this is one of the results. So the anticipated multipliers they tend to be negative, okay? And the reason is because there are two competitive, during the anticipation period, and there are two competitive effects, competing effects. One is that you know that the government spending is coming, so inflation expectations go up. That's then to reduce the real rate and to increase consumption. That's a real interest rate channel. On the other hand, there's a negative wealth effect, and therefore, because of consumption smoothing, households will reduce consumption immediately. So potentially there is an ambiguous response, and for a standard calibration is very robust. The results that demand and output decreases in the anticipation period, and therefore during the anticipation period, anticipated government spending shock, lower consumption in the monetary regime. What about the fiscally led regime? In a fiscally led regime, the unanticipated multiplier is positive. This is exactly as the monetary regime, so you cannot distinguish the two regimes if you look at unanticipated government spending. The effects are basically the same. There is another effect that sum up to the previous effects that I described here, which is the nominal wealth effect, and that's because the increase in government spending is not, fiscally backed. So there's no anticipation of future taxes, and therefore there's a positive nominal wealth effect on households. So the government spending multiplier in a fiscally led regime tends to be higher than the government spending multiplier in a monetary led regime. But what we are mostly interested in are the anticipated multiplier. And the anticipated multiplier are positive during the anticipation period under a fiscally led regime. And this is the opposite of what happened instead in a monetary led regime. So that can give you, identification strategy of the two regimes. The intuition is the same. Here there's a Keynesian effect, which is negative, like in the monetary regime. But on top of that, there is a nominal wealth effect that is positive for the same reason that I explained here. So an increase in debt is actually an increase in wealth for the households. And again, this effect is potentially ambiguous, but for most of the calibration, actually all the calibration we tried, the nominal effects dominates. And therefore, in this very simple model, what you will find is that in a fiscally led regime, that's the red line, you will have two bursts of activity. One on announcement of the anticipated government spending. So this example is an increase in government spending anticipated 4 periods before. Okay, so when government spending is anticipated in a fiscally led regime, output goes up, then it starts to go down and eventually goes up again. So there's a second burst in activity when government spending is effectively done. And in a monetary led regime, instead, the output is going down on anticipation because of the negative effect on consumption, and then it's still going down during the whole period, and then eventually will jump up when the government spending is actually implemented in period 0. Okay. So these are, as I said, this is all explained in the paper through analytical results. Then we turn to the most common, or one of the most common used indication model. We don't think, using other models, we find very similar results. So that's the Smets-Wouters model. This is on the left, you have anticipated government spending shock, which is the usual one analyzed in the literature. For the two regimes, so regime A is a fiscally led regime in which monetary policy, as you can see here, is passive. Regime B instead is a monetary led regime in which monetary policy is active. You can see government spending is anticipated for 4 periods. So for 4 periods it doesn't move, and then eventually will increase. As you can see here for anticipated shocks, so when shocks that are anticipated, then output will increase in the fiscally led regime, while instead output will go down during the anticipation period in the monetary-led regime, exactly as in this graph for the simple model. Not only, but in a medium-scale model, you can look at what happens to consumption, investment hours, and real wage. And again, basically the effects in a fiscally led regime of anticipated government spending shock is going to be expansionary on consumption, investment, total hours, and real wages, while it's going to be contractionary in a monetary-led regime on consumption, on investment, on total hours, and on real wages. So this is really a completely different picture of the effects of anticipated government spending shocks, depending on the fiscal policy mix, fiscal monetary policy mix during the anticipation period. On the other hand, if you look at the unanticipated shocks, which are the ones commonly analyzed in the literature, there's no really difference between, much less difference between these two regimes. In particular, output will increase in both regimes. Obviously, consumption will decrease. We know that. There's entire literature that look at crowding in rather than crowding out of consumption after unanticipated government spending shocks. Okay. So here the point is that if you look at the anticipation period under a fiscally led regime, everything goes up basically. So it's expansionary during the anticipation period, while everything goes down in the monetary led regime. So now we turn to the VAR and empirical results, and we show that these empirical results are coherent with this interpretation. So again, we divide the sample in two periods. This is the fiscally led regime, it's the great inflation period, and that's the monetary led regime, which is the great moderation period. First, we look at unanticipated shock. So this column here, and we use the same measure as our Bagano-Dichenko. So we look at innovation to forecast the error using SPF data. And you can see here that there's no very much difference between the two columns. Output goes up here, it goes up also here, even if it's not very significant. Consumption tends to go up in both, investment more or less, and the real wage goes up in both of them, which is exactly kind of square with this. But if you look at the anticipated shocks, so we use the Rami defense spending shocks in a larger VAR, in a fiscally led regime, you have the output goes up, consumption, well, it's not significant, but if anything tends to go up, investment tends to go up, total hours go up, and real wages go up. While during the great moderation, sample, which is in our interpretation of a monetary led regime, output goes down, consumption goes down, investment goes down, total hours goes down, and real wages goes down, and that's exactly square with the theoretical results that I just talked about. So we do a lot of robustness checks about these results in the paper. So here we are using different measures of anticipated shocks. So here in the fiscally, in the great inflation period, we use the Remy and Shapiro narrative defense spending, and we find exactly the same results. So everything goes up. And during the monetary led regime, which is the great inflation period, we turn to the Foni and Gambetti measure, which is the literature, which was proposed in the literature because there are some issues with the Remy measure, which so they are well known in the literature. So Foni and Gambetti produce other measures using the survey professional forecast of future spending growth. And again, we find exactly the same results. As you can see here, this shock is a much better shock in predicting a future increase in government spending, as you would expect for an anticipated government spending shock. And again, output, consumption, investment, total hours, they all go down. The final results, as I mentioned to you, so what happens if you go back and use the Cholesky-Blanchard-Perotti identification scheme and you divide the two samples, and you find results that are very similar to the one that one would use using anticipated shocks. So during the fiscally led regime, this shock is expansionary, and during the great moderation, instead, this shock is contractionary. So it looks like once you control for the regime, shocks may become fundamental, because there's no difference anymore between looking at anticipated and unanticipated shocks. That actually points to the fact that probably every fiscal shock is anticipated, and even if you don't take that into account, as in the Blanchard-Perotti scheme, you will get exactly the effects of an anticipated shock. And this interpretation is actually corroborated by our test of fundamentalness that I will not show it to you. We will show that if you take these Blanchard-Perotti shocks for the two subsample, they are fundamental in the sense that they cannot be predicted, while on contrary, they are not fundamental if you take the whole sample, and that's because the whole sample is misspecified if you're using a linear VAR, given the fact that these are two very different regimes and therefore imply two very different impulse response functions. So let me conclude, fiscal foresights are mostly anticipated, so important to take into account anticipation of fiscal policy. Theoretical effects of anticipated government spending depends crucially on the fiscal monetary policy mix. They're going to be expansionary in a fiscally led regime. They are contractionary in a monetary regime. Data support this robust theoretical implication, and therefore measure of anticipated government spending shocks in the literature can help to empirically distinguish between these two regimes. In the paper, we are able to reconcile conflicting results in the empirical literature regarding, in particular, fundamentalness of the shock and different results or conflicting results regarding the estimation of different VARs and the different assumptions. As a policy takeaway, you can think that it could be unwise to anticipate future fiscal policy, and that we're going to depend on the particular regime in place for the behavioral monetary policy. Thanks for listening.
Thank you for this interesting talk. So I can give the floor to Dimitri Matveev from Bank of Canada.
Hi everyone, let me try and share my screen.
You have 5 minutes.
Just 5? I thought, well, okay. Yeah, I thought I have 10, so I should be faster. Okay, thanks to the organizers for the opportunity to discuss this paper, and the usual disclaimer applies. The views are my own and not those of the Bank of Canada. Let me start with a quick recap of the main message and key elements of the paper. Basically, there are different lags, and they are in doing fiscal policy, and they're a pervasive feature. And so Guido and co-authors, they take this feature of fiscal policy seriously and study effects of anticipated government spending shocks. And it turns out that these effects depend on the underlying mix of monetary and fiscal policy. And this is the main message of the paper, that they deliver by showing empirical evidence and providing a consistent theory. Now, the results are clearly policy relevant, but they're also important for our fundamental understanding of the effects of government spending. The empirical evidence comes out of sort of using standard measures of anticipated government spending, conventional tools, but splitting sample of time into 2 periods that are usually referred to as the Great Inflation and the Great Moderation. And what happens is that anticipated stimulus turns out to be expansionary during the Great Inflation, but this effect is reversed during the Great Moderation. Now, there are different theories out there that are used to explain sort of general macroeconomic differences between the Great Inflation and the Great Moderation. And so in this paper, they take up a particular theory that assigns a key role to the monetary fiscal mix. And in the context of this theory, what happens is that the Great Inflation is often well described as an outcome of under a fiscal regime, whereas the Great Moderation is often sort of described as an outcome under a monetary regime. Now, is this theory of policy mix consistent with the empirical evidence that they provide? The answer is yes, and the way they show this is by augmenting workhorse models with anticipated government spending shocks. The way the monetary fiscal mix is modeled in this theory is basically by using these simple feedback rules for monetary policy, for fiscal policy, and different regimes are tied to the magnitudes of the feedback coefficients. Shocks to government spending here are new shocks to future spending J periods ahead, where J is the foresight horizon, essentially. Now, so with these elements in mind, let me offer a few comments. Let me start with a sort of a more broad one here. There are actually slightly different ways out there of using fiscal monetary mix to explain difference between the Great Inflation and the Great Moderation. And these different theories stress slightly different aspects of fiscal monetary interaction and their corresponding effects on the economy. And I think the empirical evidence that Guido presented is a good news for this literature, because it could be used to advance it and discriminate different theories among each other. Obviously, a natural step would be to check the consistency of other theories with this empirical evidence, definitely not as part of this paper. But then one could go a step further and actually come up with more empirical benchmarks that could be used to possibly discriminate these theories even better. And here I just sort of offer one example of that promising avenue could be looking at the state dependence of the anticipated multipliers during the Great Inflation during the Great Inflation period, where the state would be the level of government debt. Let me just skip the details in the sake of time and move to more specific comments. So I want to say a few words about the results under each of the 2 regimes. So first, consider the monetary regime here. This slide is basically just a recap of the result in the paper that reminds that the overall the sign of the multiplier is in general ambiguous. It's driven by offsetting factors, right? And the graph is just a replication of the result from the paper. So what I want to highlight here is that the strength and directions of these forces in the model actually change not only with the economic fundamentals, different structural parameters in the model, but also with the foresight horizon. And so if one extends the foresight to have a foresight of 2 to 3 years, you could actually in the small scale, in the sort of baseline model, you could have the multiplier change its sign like you see on the graph here. The key takeaway from this, I think, is that it would be nice to have a more detailed discussion in the paper about what's the empirically relevant sort of foresight horizon in the data for government spending. And if I were to guess based on some other studies of tax foresight, the foresight horizon for spending shouldn't be that long actually, and would probably be still within the range that is currently used in the paper anyways, but just having this discussion would be very informative, I think, for everyone. And then moving to the last comment here, now think about the fiscal regime. It's a harder one to work with, so there is really no closed form analytical characterization of the anticipated multiplier, even in the small scale model. So my first step here is to provide some sort of limited characterization of the anticipated multiplier in addition to the discussion that is currently in the paper. Now, the key object in the fiscal regime that affects dynamics, responses of shocks in this model is this debt valuation equation that you see here on the slide. I mean, it's a very natural equation. What it tells you is that real value of debt has to be equal to the present discounted sum of primary fiscal surpluses. Right, now think about the anticipated shock to government spending. What it does, it unambiguously, so think about this anticipated stimulus, it unambiguously lowers the surpluses here. Right, and what for the equation to hold, basically, what has to happen is that anticipated stimulus has to be absorbed either by current inflation or by sort of a lower path of real discount rates. You know, one can do it, or both components could do it. Now, what about the effect of the shock on output, so the multiplier of interest? Well, this is a model where aggregate output and aggregate demand and output are ultimately sort of driven by the intertemporal substitution. So output here is high whenever real interest rates are low. So now, if I haven't lost you here, yeah, then it should be relatively straightforward to see that a necessary and sufficient condition for the anticipated multiplier here is that anticipated shock to government spending should be accommodated by inflation, not fully, and instead there should be some accommodation by a decline in the real rates over time. Now, the first half of the slide here just says the same thing, and with this characterization, what I want to do is I want to highlight the role of monetary policy in affecting the fiscal multiplier, the spending multiplier in the fiscal regime. Meaning that what happens here is that although monetary policy is passive, it still adjusts nominal interest rate in response to inflation. And the magnitude of this feedback, although it's less than 1, it's still an important factor that affects the dynamics of the real interest rates in this economy and ultimately the multiplier. So the last slide here is basically, gives you a graph that shows how the multiplier, the anticipated multiplier in this model changes as you vary the strength of the feedback in the monetary policy rule. And so focus on the blue line here, and as one starts increasing this feedback coefficient from 0.5, which is the value that is used in the paper, as you increase the feedback, the multiplier starts declining and then eventually even turns negative. Basically, again, so the takeaway here is similar to the other regime, where I think it would be beneficial to discuss what's the empirically relevant range maybe for this parameter, and specifically, I think the literature that Guido mentioned, the literature that estimated models to identify regimes, right, and associated great inflation and great moderation to these two specific regimes. So hopefully, some of those models and their estimates could be informative to discipline this parameter here. And yeah, I think I ran out of time, so I stop here.
Thank you. I don't think we have any questions, and we are a little bit behind, so we don't have that much time to answer the questions. But I still encourage you to ask the question in either chat and Q&As, and the presenter will be able to answer them there. So we move.
Let me just thank Dimitri for the thoughtful discussion. Thank you.
Thanks. So we move on to the next speaker. So in the poll, we had the question about whether during recession the government should stimulate aggregate demand, aggregate supply, or depending on the state. And most of you answered that it depends on the state, although there was a large fraction that actually supported stimulating aggregate demand, and nobody wanted to stimulate aggregate supply. So I give floor to Francesco from University of Oxford. You have 15 minutes.
Thank you. Yep, sorry. So first of all, thank you for having me here presenting this nice paper that is co-authored actually with Michel Gassibe, that is a student in Oxford, but is also an employee at the National Bank of Ukraine. Misha will be on the job market this year, so I think that you should watch out for him. So this project is about the state dependence of fiscal policy, and the source of fluctuations matter. So to link it with what the poll asked, our view is that if you want to know what is the effect of a fiscal multiplier, both in government spending and taxations, you need to know and you need to look at the sources of fluctuations. And what we do in this project, we build up a model that tells you how the sources of fluctuations matters for the fiscal multipliers, and then we take the model to the data, and we show you that in an unagnostic, if we estimate the data without any structural model, just looking at local projection methods, that's what the data tell us, that you need to control for the source of fluctuations to know the size of the fiscal multipliers, both in government spending and taxation. So the paper is, this is a rich paper. Oh, it's jumping. This is a rich paper. So what I will do in this presentation, I will present the main findings, and you can refer to the paper if you want to see the specific. But what is the motivation? So we started to work on these papers because what Rami and Zubairi find is they talk about the relevance of fiscal multipliers, but they say that there is still not, apart from papers that are focused on the zero lower bound, and our discussant too has a nice paper on it, there are not very many papers that they have a theory on why the fiscal multipliers should be state dependent. And so what we do now, we show you that in a general theory based on trading, basing on goods market search, where workers and firms, they need to meet in order to do purchases. In that simple theory, you have strong state dependence of fiscal multipliers. So that's what we do in this project. So why is the state dependent important? So here we have that in the, oops, it's jumping. So there is an empirical debate that on one side, Yuri and others find that state dependence is important, but on the other side, Rami and Zubairi, they question it. So what we do in this project, we take Rami and Zubairi seriously, but we show that if we control for the state, for the sources of aggregate fluctuations, we do find the state dependence that other studies establish. And to do so, we develop a theory. And typically, before us, apart from the zero lower bound and some financial frictions papers, there is no theory that tells you that the fiscal multipliers is different across states. You can change the state from S to S prime. The response of output to GDP, response of output to fiscal spending is the same. In our theory, we break this relationship. We will have that the response of output to government spending will be different. So what do we find? What is the big takeaways of this project? So the big takeaway is that we develop a general theory where we have search and matching in the goods market, and therefore we generate idle capacity and unsatisfied demand. I.e., not what is in the shop is sold, and if our customers wants to buy some goods, he will need to pay for those goods, but that's also for the cost of buying those goods. And that I will show you that it will introduce some cyclicality of fiscal multipliers. And how is this cyclicality? Well, we have that spending multipliers are high in demand-driven recessions and low in supply-driven recessions. So here you need to think about the government going to a shop. The easiest way to think about our model is that there are shops that they sell goods, and the shop has a given capacity. And then there is a demand. The demand can either be the government or the private sector. So if the recession is demand-driven, i.e. private sector, suddenly the demand falls, then having the government that steps in, it generates stimulus. But if the recession is supply-driven, i.e. the shops shrinks and the government injects government spending to stimulate the economy, it crowds out a lot of private consumers. And so the multiplier is low. And we find the opposite for a tax cut multiplier. Those are large if it's a supply-driven recession, meaning if the shop shrinks, then reducing taxation gives incentive to expanding the shop. But if it's a demand-driven recession, if we decrease taxation and we enlarge the shop, we have more unsatisfied demand. So it's not a very effective way to stimulate the economy. So those are the key results of our model. We also talk about fiscal austerity, that if the economy is overeating and it's not very sensitive, and if labor market is rigid, that is not very sensitive to tax cuts. So the best for the government is withdraw government spending. So this model, I will not talk about it in this presentation, but this is also a nice result of our paper, that we don't need to rely on justifying austerity based on credibility of the government. It comes out, it's another way to, when the economy is overeating, to let the private sector purchase the goods. And finally, what we do based on these intuitions from our model, we go back to Zubairi and Rami and we say, well, let's look local projection and let's control for the state of the economy, whether it is a supply and demand shock, and let's see whether fiscal policy and the multipliers are in line with our theory. So what I'll do now, I'll show you the essence of the theory. As I said, the paper is fully micro-founded, but I won't have time to go into the details, but I want to give you the intuition on where the state dependence comes from, what are the main results, and then we look at the estimation, empirical estimation. So where do we depart from standard model is in this equation. This is the standard equation that says supply output Y is equal to demand. Demand can be the private demand or government or demand from the government. What we do here is that we micro-found our economy saying that goods needs to be purchased and there is idle capacity and unsatisfied demand. And so we will have a wedge between the supply of what is sold and what is purchased by the consumers. How do we introduce this wedge? Well, we search and matching frictions. So this is the only slide where it is just full of equations. There will be another slide, but then that's it. Our framework builds on Michelite and Size 2015. And basically, the essence is to say whatever the sales in this economy, they depends on the shop size and on the queue line. And if we do this, then we have this notion of tightness that is the queue divided by the shop size. You can think that this is a sort of output gap, is demand divided by supply. And if demand is large, that is good for shops. They can sell a lot. The probability of selling increases. But if the demand is large, that is bad for consumers, that the probability of having a successful visit goes down. There are now many people lined in front of these shops. And so now just looking at this, that will create a trade-off between firms and consumers, that when tightness is large, when demand is large, firms can sell more, but customers, it is more expensive to buy because the line is longer if there is a lot of demand. And so that then basically changes the micro foundations of the model. And we have that now the household to purchase goods, it needs to pay a cost on top of the goods cost, which is the cost of standing in the line. And so it is costly, tightness for households. It is instead enhancing for firms because it increases the probability of selling goods. And the government, in the simplest version of the model, is like the household. It's just the private sector that needs to stand, buy equipment, and build bridges. And so it is costly also for the government to stand in this queue. So the model, basically, the wedge is here. So here you can think that this is the capacity of the shop, you can think of this as output, but this is sales, is actual sales, and this is actual demand. So now here you have a trade-off, because as tightness increases, this F will go up, but also this gamma will go up. And so there will be a point in which this second effect dominates, and therefore, if demand is too large, then consumption, private consumption will fall. And so this is very much the model. We have goods market equilibrium and labor market equilibrium. Now, what we do now in the context of this model, we derive the fiscal multipliers, and we look at government spending, G, and taxation, K. So the details are in the paper, but so how much do I have left? 10 minutes or?
5 minutes.
5 minutes. So the details are in the paper, but we derive basically the fiscal multipliers. And one first result is the following. We look at, let's keep the capacity of the shop fixed. Let's keep the capacity of the shop fixed, that there is no capacity. And let's see what happens to the fiscal multiplier when we increase government spending. So what happens is that by increasing government spending, the fiscal multipliers always decreases, because the government will step in to buy goods, and we will make it the line more longer for the private sector to buy those goods. And so the multiplier, the fiscal multiplier in government spending decreases with tightness. So the higher is demand, the lower will be this multiplier. And the multiplier can become negative if the line is extremely long. Let's suppose now, let's relax the assumption that the supply is of labor is fixed, so that the capacity can also adjust. And so that is the more general result in our paper. What do we find? That the demand multiplier basically decreases in tightness. And so the tighter is the goods market, the more effective is the fiscal policy. So here, I think probably this graph makes a better results, that when tightness increases, the fiscal multipliers to government spending decreases and potentially can become negative. We look also at the supply side multiplier, i.e. a decrease in taxation. Well, a decrease in taxation stimulates capacity. So as demand increases, as tightness increases, stimulating capacity is good, because the government can satisfy more demand. And therefore, what happens is that the supply side multiplier, the one related to taxes, increases with tightness. So this is the results of this paper. So we have the tightness increases the supply side multiplier. So when the goods market is very tight, taxation can be very effective if the labor market is elastic. But if the demand is very large, government spending is ineffective. Then what we do, we relate the two, we create, here if you are a government, here we have a rule that tells you which policy you should be using. And which policy you should be using depends on tightness. You look at tightness, the larger is tightness, the less effective is demand stimulus. And if tightness is sufficiently large, demand stimulus can become also negative, because there is a large crowding out effect. Then the final results that we show, that I'll show you today, is about the empirical results. So now here what we do, we go back to Rami and Zubairi, the 2018 paper. And we ask ourselves, if we want to estimate, we use local projections and we use their method. We say, well, let's estimate the response of GDP to government spending. And here, what they do, they say, well, it's not state dependent, they find, because if we control when unemployment is below or above the threshold of 6.5, the estimate is similar across the two, is not very relevant. So what we do, we complement this with our theory, saying, let's control if it is a demand-driven recession or a supply-driven recession. And we define a demand-driven recession when we see a negative co-movement between unemployment and inflation, i.e. that unemployment goes up compared to the threshold, and inflation instead falls. Compared here, we use trend inflation, but in the paper there is a battery of robustness results. So when we see these co-movements, the co-movements between unemployment and inflation will tell us whether it is a demand shock if the co-movement is negative, or a supply shock if the co-movement is positive. So when we do the estimation, what we want to find is that this term is very large. If it is a demand-driven recession, the contribution of government spending to GDP is large. And that's precisely what we find. Here in column 3, we find that when we control for a demand-driven recession or supply-driven recession, the effect of government spending in a supply-driven recession is much larger. And my final picture before concluding is this one. Here we have those coefficients at different horizons. We have the coefficients of how government spending reacts to taxation, how the multiplier reacts to, how GDP, reacts to an increase in government spending. If it is a demand-driven recession, the red line, or if it is a supply-driven recession, if the green line, or if we don't control for that. And as you see, there is a huge difference. Now here we don't have the error band, we will add them. But if it is a demand-driven recession, then government spending is very effective. If it is a supply-driven recession, it's not. If output contracts and if government spending increases, if the size of the shop contracts, and government spending increases, having extra government spending makes more crowding out of private
I would suggest going to the conclusions because the time is running out.
Yes, to conclude, we look at the fiscal multipliers, and we found that state dependency is important, but you need to know the source of macroeconomic fluctuations. And with that, I'm done. Thank you.
Thank you very much. And we move to the discussion by Thailand Nguyen, if I pronounce it correctly.
Yes, Thailand Nguyen is fine. Hold on a second. You see my screen?
Yes.
Okay.
I think you can full screen.
Yeah. So thanks so much for the organizer. Yeah. So thank you for the organizers for inviting me to discuss this paper. So the usual disclaimer applies. I'm going to summarize the paper very quickly because Francesco was really great at presenting his paper. So the main question of this paper is to understand how the state-dependent multipliers arise. And the approach that they use in this paper is to write down a theoretical model that has a search and matching friction in the goods market, and then they actually support their mechanism or their theory's prediction using US data between 1909 and 2015. And I think my overall impression is a very important, a very rich paper. This has 91 pages. It does take a lot of time to digest the paper, and it does. I think it shows that not just the business fluctuations that matter for the business cycles, but also the sources of the fluctuations. And I think I'm going to discuss more of this in my discussion. But the idea is that I think what is important in this paper, and I think Francesco didn't stress that enough, is that they consider both government spending and tax instruments in the paper and provide empirical support. So the main mechanism I'm going to go through with this very quickly because it has been explained very well. So the action happens when the prices are rigid. So you need some kind of price rigidities. Otherwise, when price changes, the tightness is the mechanism is not going to go through. And in a nutshell, in a demand-driven recession or a supply-driven expansion, the idea is that there are a lower number of visits to the store, and then tightness fall. And so depending on whether you have government spending or the taxes, the effect on the aggregate is different. So when there's government spending increase, there's a smaller crowding out effect on private consumption because the tightness is already, the visit is already low. And so the multiplier can be larger. So you get a counter-cyclical government spending multiplier in the demand-driven fluctuation and a pro-cyclical government spending multiplier in the supply-driven fluctuation. Okay, but when the difference is when you have tax. So the tax in a demand-driven recession with a lower tax, you have a higher labor demand, higher capacity, so the tightness is lower. But given that the tightness in the economy is already low, the effect of tax in this case is not going to be as large as in the case when you have a higher tightness in the market. So then you get actually a reverse effect of tax multiplier compared to government spending multiplier. That is, you have a counter-cyclical tax multiplier in a supply-driven fluctuation and a pro-cyclical tax multiplier in demand-driven fluctuations. Okay, in the model also is the standard, just like a standard model, government spending multiplier is not over 1. Okay? It's below 1. So first, I'm gonna put this paper in the literature a little bit to see the contribution of the paper. In terms of the theory, there are actually 2 papers that are closest to this paper, and I'm going to discuss them a little to put this paper in the context. The first one is by Banichon and his co-authors, that is in the restart. The idea of that paper is that they try to show that in the state-dependent multiplier can arise in a model with incomplete financial market and downward nominal wage rigidities. Most of these frictions they show that can generate asymmetric and state-dependent multipliers. By that, I mean, they show that these frictions generate a convex aggregate supply curve. And so whether you want to increase government spending or decrease government spending, that the multipliers would be different. So the sign of the shock matters. Okay, and so in some sense, it's very it has the same flavor as this paper because the aggregate supply curve is convex. And so you can think about this as if you are in a recession, then increasing government spending has a larger effect on output than when you're in expansion, when you are in the more steeper part, of the aggregate supply curve. Okay, but then this paper didn't focus on the source of fluctuation. It didn't talk about demand versus supply shocks, and so that's where Francesco's paper fits in to contribute. The closest paper, and I think this is the paper that was written after Francesco's paper, but it's very close to this paper, so I want to draw attention to compare this paper with that, with Francesco's paper too. So that paper is by Joe and Yunjo and Zuberi. That it was relatively new. So in that paper, they have a new Keynesian model with downward wage nominal wage rigidities, and the whole mechanism works through the downward nominal wage rigidities of friction. Okay, and actually that in that paper, the authors also consider demand versus supply shocks, driving business cycles. Okay, and in their model, the demand and supply shocks have opposite effects on inflation, and that's exactly what Francesco also used in the paper in the empirical part. Okay, and in the contractionary demand shocks, contractionary demand shocks lower inflation, and so when the downward nominal wage rigidities binds, the real wage increases, labor demand falls even more, so that creates unemployment in that model. And so government spending actually can increase labor demand without increasing real wage. And so it has a large effect in the recession that is driven by by demand shock. In contrast, when you compare a negative in a recession that is driven by a negative supply shock, inflation falls, and so real wage also falls. And so labor demand falls by less if you compare it with a demand-driven recession. And so actually government spending in the negative-driven recession would increase labor demand, but also real wage. And so actually the conclusion is that the effects of government spending in the demand-driven recession can be larger than the supply-driven recession. Okay, and so this paper and Francisco's paper are consistent in the recession prediction, but in Joe and Zuberi model, there's no asymmetry in an expansion. The reason is that the major mechanism in that paper is downward nominal wage rigidities, which binds in a recession and doesn't bind during an expansion. And so they don't have any asymmetry in the expansion. And they also don't consider tax policy. So that's where the main difference come from of these two papers. In terms of the empirical contribution, so we have seen, this paper and the previous paper talking about, the large literature on different, on the government spending multiplier and tax multiplier. The main innovation in this paper is that it's tried to distinguish the multipliers based on the sources of business cycle. And I think it was really clever to try to use the inflation output co-movement to identify the periods of, supply or demand shocks driven expansion or recessions. Okay. So a little bit of my, nitpicking comments here. In terms of the empirics, I think the question that I have in my mind when I read this paper is, can theory help to explain different findings in the empirical literature? So Francisco said, yes, they used he used Remy and Zuberi data, and they found the difference between the multiplier in the recession driven by demand shocks versus supply shock. But I think what is crucial for me, at least, to understand is that, does it mean that because Remy and Zuberi versus Yuri's paper, they have different data samples, so they cover different recessions? That's why you get markedly different. Okay, so I think so because the multiplier, when you just look at recessions versus expansion, you have that's like an average multiplier, right, between demand driven and supply driven recessions and expansion. And so if I want to push the authors a little bit more to see, okay, so suppose if you do the same thing for Yuri's and Orbach and Gorichenko sample, and you do the same thing, do you get the results supporting the theory? I mean, in the end, I want to see that, okay, maybe the results that are different between Remy, Zuberi, and Orbach, Gorichenko is that they just covered a different mix of of supply versus demand shocks, and that's why they are different. So instead of just separating the two, I mean the sample into expansion versus recession, demand driven versus supply driven recessions and estimate. And then I think another point of the empirics is that I think the theory, what distinguishes this paper versus, say, Joe and Zuberi paper is that the theory predicts that the multiplier are different in both expansion and recessions, and I think that it's still kind of missing in the paper, because so in the empirical part, they distinguish the demand-driven recession versus supply side recession, but they didn't really show the expansion results, and they did only show that in the appendix. And I understand that there's some kind of there's enough space for it, but I think that's the part where you distinguish your mechanism versus the other mechanisms. So I think it's important to highlight. And what worries me a little bit is that the results do not, so when Francesco presented, there was a table that shows the difference in the multiplier between the supply and the demand-driven recession. But I think the p-value between the two are not significantly. P-value is larger than 10%, which I think.
Could you please wrap up slow, because we are running out of time.
Yeah. So the p-value is a little bit, higher than the conventional value. So, there might be some other way to estimate. So, for example, you look at OECD countries, how does it look? And there's also Banichon's method that they try to more precisely estimate the multiplier when you have a lot of state interactions that may have. And I think also, you use the same data as Joe and Barry, but they have a significant result. So, you may want to think about a little bit more about the threshold of the inflation when you do the demand versus supply driven recession. And I would be interested if if the paper has a little bit more more variables to test the model mechanism, like consumption.
We are really running out of time.
Oh, okay. I'm sorry. So just one more thing. Okay, so in a model, I think there's one. I can send this to the authors, but I think in the model, one more thing that I find a little bit missing is that some empirical papers find multiplier larger than 1, and in this model you never get that. So do you want to get some comments on that? And I think that in the dynamic model, when you calibrate the model, I think you need to target the moments in the data or match moments that identify the empirics a little bit more closely than just say, oh, the sharp process is common, is 0.9, but then that doesn't, it looks to me that it is a little bit arbitrary. So I would suggest to look at, calibration of the model is a bit more precise. Okay, so just the conclusion is a very interesting paper. I had a great time reading the paper. I learned a lot. The story makes a lot of sense to me, but I think testing the mechanism can be a bit challenging. That's it. Thank you. And sorry about the timing.
Thank you for the discussion. Let me see if we have any questions.
Let me thank Twin for this nice presentation and comments on our findings. And yes, do please send me the slides. I want to look at them carefully. But let's see if there is any other comment. Sorry to interrupt you, Christoph.
So I don't think we have time to answer the questions on screen, but I encourage you to send the question via the Q&A or the chat directly to the speakers. So thank you for these interesting talks. I think the whole conference was very good, and now I give floor to Dimitri Sologuov, who will conclude the conference. Thank you very much.
Dear colleagues, first, let me thank you for being with us in the last 2 days. 12 months ago, when I was making concluding remarks at our 2020 annual research conference, I noted that we all hope that 2021 event will be back into the usual offline format. It unfortunately didn't, which in my view, once again, clearly illustrates the point that despite all this technological, medical, intellectual, and other advances which we human beings made in the last decades, there are still powerful exogenous forces which we cannot control. So, on the other side, I strongly believe that the way the medical workers, scientists, economists, politicians, and other professionals have been fighting this unprecedented crisis clearly indicates that our civilization is not helpless and has a bright future. The remarkably fast emergence of the vaccines against COVID-19 and the rapid pace of vaccination, though we all wish it should be even faster to limit the spread of the virus in the developing countries, seem to bring us closer to the return to the normal life. Hence, in this respect, as our last year conference was actually one of the first events held online, now I do hope that 21 annual research conference actually would be one of the last events held online. And in the second half of the year, most of the events will switch back to the normal offline mode. Now, let's talk about our conference. I think we had a good event, though I need to assure that my facial expression and tone of voice confirm that I am happy. Well, for sure, the excellent paper by Filippo Curti and Sofia Kazinik, supplemented by the insightful remarks by Alexander Talavera, provide a lot of food for thought for the policymakers. As we central bankers know, the verbal communication became very much the centerpiece of our policy efforts in the last few decades. Now, apparently, we should go further and carefully control not only what and when we say, but also how we say that, and even how we look like when we keep silent. That honestly is quite scary. The need to control emotions while speaking to the public is not the only challenge the policymakers and central bankers around the world are facing in the post-pandemic world. Elevated public debt levels, global inflation, capital markets frenzy, labor market imbalances are just few to name. Moreover, on the top of that, several notable challenges existing before COVID crisis did not go away and further rose in the prominence, namely the climate change, the rising income inequality, and the powerful rise of the fintech industry and digital currencies in particular. And I was pleased to see that our conference participants, speakers representing academic and policy institutions from all over the world are striving to find the answers to these questions and challenges. I would very much agree with Professor Blinder that the best central banking practices carved in stone during the last 3 decades had a challenging time during this crisis and had to be largely reversed. So, from the point of view of practitioner, I would also note that the emerging markets in the emerging markets, some of these practices have not been so pure already. As we heard from Governor Gvenitadze yesterday, the central banks in the emerging world, facing a number of challenges and uncertainties, normally have to act fast and go big. Also, in the crisis times, you are very often facing the dilemma of illiquidity versus insolvency, as well as the lack of good collateral. But now, when the worst of the pandemics is hopefully behind us, the question, which was prominently raised by Professor Blinder, is how to head for the exit in terms of economic policies. We know that the economists have a number of established economic models which help to model the way the economy emerges from the conventional economic crisis and how the policy response should be structured. However, this time is different. We are facing the global shock of the unprecedented scale caused by non-economic factors. Thus, it's not so easy to model the way out of this crisis by using conventional economic models or empirical evidence from the past global pandemics or wars. The global economy changed a lot, both since global Spanish flu pandemics 100 years ago and Second World War. But despite all this drama of this crisis and uncertainties lying ahead, I am pleased by one important fact revealed by this crisis. Good policies matter. This is particularly important for us in Ukraine. The country has been bouncing back and forth between the crisis for the last 30 years. And now, for the first time, the economy weathers the crisis relatively well. In my view, it should be attributed to the remarkable policy changes in the previous years: flexible exchange rate regime, prudent fiscal policy, sound and transparent financial sector. All this was not so easy, but now it pays off. The one important thing I'd like to highlight here: the quality of institutions. The optimal policy mix might change over time, but if you have strong policymaking institutions, they would be able to adjust to the fast-changing world. This is definitely the case for the central banks at the moment. The times ahead will be challenging for them, venturing into the uncharted territories, trying to deal with all these problems I mentioned above. Moreover, the political landscape is not likely to be conducive for the independent central banks. The timely withdrawal of the monetary stimulus and appropriate tightening of the regulatory standards may not be politically viable. And strong and professional institutions based on the principles of transparency, integrity, and collegial decision-making is the best answer to these challenges. So now it's a time to drop the curtain. And I'd like to thank once again to all speakers and the participants of the event. And the special thanks goes to the organizing team, which includes a lot of wonderful people who worked tirelessly to make this event happen. You know, I have been chairing the organization committee of this conference for the last 6 years, and I'm honestly lacking words to express my gratitude to all my current and former colleagues in the National Bank who worked with me on this, our friends from other institutions, namely Professor Yuri Gornichenko from University of California, Berkeley, Alexei Krivtsov from Bank of Canada, Mariana Kudlyak from Federal Reserve Bank of San Francisco, who was helping us with the previous conferences. And definitely, of course, I should not be silent on how I appreciate the help from our long-standing partners in organizing this event from Narodowy Bank Polski. So I'd like to thank personally to Governor Glapiński, First Deputy President Keightley, our excellent colleagues from Economics Department, Michał Joseph Brzezina and Krzysztof Makarski, and definitely wonderful people from Narodowy Bank Polski International Department for their great support. So now I have to turn my facial expression to sadness and conclude this wonderful event. Thank you and goodbye. Так, ну что, нормально?